The Fed's laser focused on the labor market.
If the jobs data does diminish, I think they have to go ahead with the 50 basis point cut.
I think it'll be a decent payroll employment report.
We're going to have a pretty messy payrolls.
This jobs report that we're going to get this week, this should be clean, but this might be the last clean one, at least for a couple months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend. We're coming into Friday with a little bit of good news. Cancel the trip to Costco. Put down the full cart of toilet paper. The strike is over. Live from New York City this morning. Good morning, good morning. It is Payrolls Friday. Your equity market looks like this. On the S&P 500, higher by 0.2%. On the Nasdaq 100, up by a quarter. The main event, 2 hours, 30 minutes away. It's Payrolls Friday. Your estimate in our survey, 150K.
As long as it's between 125 and 175,000 jobs that we get on this headline print, Michael Hartnett over at Bank of America thinks that risk assets do just fine because essentially this would be the Goldilocks nirvana that everyone's looking for. Outside of that band, good luck. And that, I think, is what a lot of people are wondering about.
Look, the White House this morning is breathing a sigh of relief, I think, before we even get the payrolls report, whether it's negative or positive, because we've been talking about the last week. What is it going to be the following payrolls report? Because it's going to be so messy. Because the dock workers, and I have to say, they're back to work after 3 days. This is a big win.
Let's talk about some mess then. Away from that, let's talk about the commodity market. Crude, 4-day winning streak. WTI and Brent up again by almost 1%. Just short of 80 on Brent, just short of 75 on WTI. The president asked a simple question. Kind of muffled that answer, didn't he?
He was asked, would he support an Israeli strike on Iranian oil facilities? And he said, quote, we're discussing that. So two things come to mind here. One, the president has himself to blame for the spike in crude prices yesterday, which isn't great ahead of a presidential election when Americans care so much about the price of gasoline. And then you have to think, was the president just being honest? We've seen him do this in the past, very transparent when he was asked by actually a Bloomberg reporter in a news conference once about Russia's invasion of Ukraine when Putin had troops at the border. And he said, well, it depends on minor incursions. And then it was cleanup again on aisle 6 when it came to Jake Sullivan and the national security team. He walked that back a little bit and said, I don't want to negotiate in public. But the problem is, this is almost like a liability now when he talks to the press.
Lisa talked about this yesterday. What does this commodity market mean to the bond market? Crude up big time yesterday, and bond yields moving in the wrong direction.
Which is the reason why people are wondering exactly whether they are the haven asset in some sort of shock. Question about whether this can stick. Question about what we're discussing that. I think that would be a little anyways actually means. And I think a lot of people are trying to parse through Joe Biden's response yesterday to those questions. Nonetheless, has this market priced in too much accommodation and too little with respect to some of the inflationary shocks coming down the pike, whether it's oil or whether it's fiscal?
We're talking about it, kinda. Anyway, crude up 5%, just like that. Equities right now on the S&P 500 up by 0.2% as we count you down to Payrolls Friday. In the bond market, the 10-year up a single basis point to 385.34. The next hour looks like this. We'll catch up with Chris Verrone of Strategas, head of key payrolls data. Seth Harris, the former acting Labour Secretary, as US dock workers agree to end a 3-day strike. And Wells Fargo's Michael Pugliese on how low the bar is for another outsized Fed rate cut. We begin this hour with stocks steady ahead of payrolls at 8:30 Eastern Time. Investors looking for clues on the health of the US economy. Chris Verrone of Strategas, a Baird company, writing, this is equally the most fluid and interesting macro environment we've seen in years. Tech continues to cede leadership. Relative performance is again flirting with the August-September lows, and internals have softened. Chris joins us now for more. Chris, good morning.
Great to be here. Happy Friday.
Why is this so amazing for you? Is it just decidedly convictionless? What is fluid about this?
I mean, you have this intersection of the Chinese going big, the Fed cutting, giving 50 basis points, probably leeway for the rest of the global central banks to do the same. You have what the Saudis did a week and a half ago. So you have this intersection of this remarkable macro landscape. And I think it's a really exciting time to be doing what we all do here.
You always say it's not my opinion, it's what the market is saying. What's the market saying?
I think the market's telling us here, don't be surprised if yields bounce for at least a few more weeks. And that's a change of view for us. We've been so ardent in this bullish bond call for much of the year. I think we've done a lot in a short period of time on rates. We took 10s from 475 to 360. It's actually not uncommon following the first cut of a cycle to see yields bounce. I think that's what we're in the middle of here. I could see 10s, even on an inline report today, starting to drift back up towards the maybe 410, 415, maybe 420 neighborhood. I ultimately want to be a buyer of bonds again. I just think that's a little bit down the road. And what you've seen, John, you've seen rates, dollar, oil, all really correlate with each other here. So something's certainly brewing on that front.
To me, this is actually fascinating. You point to the fact that the dollar is also bouncing, and you think that eventually will weaken as well, but essentially it's going to follow the yield trend. You also talk about how the tech fundamentals are softening when you look at just sort of the charts. Can you talk about what exactly is going on? Is this basically just a market that kind of exhausted itself with this soft landing nirvana, broadening out, and now suddenly you're feeling sort of the last gasps of that?
Well, it's funny, the question we get in a lot of meetings is, Chris, do you think we'll get a soft landing? And I kind of scratch my head at that question a little bit, because this market has traded soft landing for the last 18 months. I mean, what could have been more soft landing than rates down, than tech up, industrials and financials leading? So I think the appropriate question is, what comes after soft landing? I think the consensus for a long time has been in the view that, after soft landing, you ultimately get the slowdown. I'm not so sure of that, particularly with the Chinese stimulating here. We at least have to ask the question, on the other side of soft landing, do you get some global reacceleration? And I wonder, if you do get a global reacceleration, is that what rates or crude or dollar or maybe tech's modest weakening of relative is starting to tell us here? So certainly top of mind.
So at what point would you say this is something more than just a technical blip and something that is durable?
So I'll say it like this. When you look at tech in particular, I think if you got some global reacceleration with rates up, with dollar up, I would be surprised to see tech really reclaim the flag of leadership here. And I think when you look at the internals of tech, which you note, you're down to about 60% of tech stocks in uptrends. That's not fatal. That's not catastrophic. That's not. But it begins to get tougher to consistently make money when the internals are weakening. You've seen that in tech. I think just look at the character of this market the last 8-12 weeks. What's made a new high? Equal weight S&P has, semis have not. Right? Value line has, NYSE has, S&P 500 tech has not, Qs have not. So just the character of the advance, I think, has changed in a very real way.
The Chinese stimulus is adding to this fuel and excitement in the equity markets, but really in China. How much is that holding back some of these U.S. stock names?
Well, I think when you look at the move in China, and I say this emphatically, I've only seen something like this once or twice in my career. When you look at the internals, the potency of the move, it's unprecedented. 90% of the Hang Seng make a one-month high this week. I mean, you have to go back to late 08, early 09 to find anything even remarkably in that category. So I think the equity market is saying, at least be open to this being the real deal. I think the question we have to ask ourselves, every durable rally in Chinese stocks over the last 20 years has been accompanied with bond yields rising. So if you look at these Chinese 10s or Chinese 30s, they have to confirm this move. You had a very big move higher in these yields the last 2 weeks. I think that has to stick if we're going to believe this move.
I also want to ask you about the U.S. election. As you're so excited about the macroeconomic environment, you write that your colleague says it's the most exciting election of her lifetime. So what are you doing ahead of that excitement?
Yeah, so I think we have to look at history here. And what we've seen historically is a weak market in October. The challenger tends to win. A strong market in October, the incumbent tends to win. So just from the market's interpretation, I think the next 3 weeks are certainly crucial from that perspective. But maybe more importantly, let's think about all of this intersection between really some changes over the last 2 or 3 weeks, right? We had a very accommodative oil market, maybe not so much anymore. We had a very accommodative rate market, perhaps not so much anymore. So a lot of the kind of key macro variables that we think impact the election have started to shift over the last 2 weeks.
There seems to be a takeaway for equities that Trump sweep, bullish, Harris sweep, bearish. Is it that simple for you?
I think it's probably that simple in the near term.
Does it get complicated?
I would suspect it gets complicated as we move into 25. I mean, the reality is when Trump won in 16, we went to then doing taxes. In this case, on a Trump win, we have to renew taxes. I think it's a very different view of how the market will interpret that, because if you do nothing, they expire. And you're going to get to the second quarter, third quarter of 2025, irrespective of who's there. And you're going to have to either get this done or it's going to expire. And I think the market will be a very good tell on kind of what's the cyclical impulse behind that.
Just think about the timeline. How quickly do they move for tariffs and how disruptive is that early on?
This is where I think there's maybe some distance between the consensus and how the market interprets it. If you think about it in a very traditional way, that's going to be bearish China or bearish industrials here. But that's not the message of the market here yet. So I'm always in the game of, okay, what is the consensus thinking and where could they be surprised? And I think there could be a surprise here, at least relative to expectations that tariffs in a second Trump administration are not as punitive or as potent as being talked about here.
So you don't think necessarily the risk when it comes to the election lies in the bond market as much as people think?
Yeah, I think if anything, maybe, we trade rates up here 415, 420 over the next 4, 6, 8 weeks. And then you actually start thinking about, again, even in a Trump win, when do you start to buy bonds again, right? If the whole kind of impetus of a Trump 2.0 is how do we take our foot off the fiscal accelerator and still manage a relatively modest or benign economic environment, that actually ultimately sounds like rates down, not rates up. So I'm not convinced with this kind of consensus view that if Trump wins, you get some huge move higher in bond yields. History doesn't support that.
Huge with a Y. I noticed that, just sort of an echo of what the former president himself would say. What are you comfortable being long in the super short term then in the equity market?
I think in the very short term, I want to be long some energy here. I want to be long some crude. I still want to be long some industrials. I think we got to keep an eye on these financials. We've been very bullish on banks for 18 months. They're starting to weaken here a touch. That's a change of view for me. These, Bank of America has softened. JPMorgan has softened. Is it a credit story or a
rate story? What do you think that is?
I think it's a rate story, but it's a change. And anytime there's a change from what the status quo has been, my antenna goes up. And I think there's a little bit of a shift going on in these financials, particularly like the Japanese ones. The European financials have started to weaken here a little bit. So my antenna is up on global financials.
Final one, Japan. You thrown in the towel?
We've been so long for so long. I think it's time to at least begin to back away. These Japanese banks are starting to weaken. That is the biggest change in our work probably over the last several years. They have been the kind of the tenet or the key of any big macro call, be long Japanese banks. Why are they starting to weaken here? I think it's a question worth discussing.
Chris, it's good to see you.
Thank you.
Appreciate it. A question we'll discuss next time. Chris Verrone of Strategas, a bad company. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Shanali Basak. Hey, Shanali.
Good morning, John. A prolonged strike has been averted. U.S. dock workers have agreed to end a 3-day strike that paralyzed trade on the U.S. East and Gulf coasts. It threatened to become a factor in the presidential election. The International Longshoremen's Association and the U.S. Maritime Association have announced the decision to extend their previous contract through January 15th of next year. Work will pick up again today, and the two sides will restart negotiations for a long-term agreement, which will include a pay increase of about 62%. And people familiar with the matter telling us that the European Union has voted to impose tariffs as high as 45% on electric vehicles from China. The results have not been publicly made available, but the European Commission can now proceed with enforcing the duties. Sources tell Bloomberg that 10 members voted in favor, Germany and 4 others voted against, while 12 abstained. China has threatened its own tariffs on European dairy, brandy, pork, and cars. And Elon Musk is emphasizing his support for Donald Trump once again. The Tesla CEO saying that he will attend a rally that Trump is holding Saturday in Butler, Pennsylvania. That's the same location of the first assassination attempt on the former president. Musk has already committed millions to the Trump White House bid, including a super PAC that he started that has spent $71 million, mostly on canvassing and field operations to get out the vote. And that's your Bloomberg Brief, John.
Hey, Shanali, thank you. More from Shanali in about 30 minutes' time. Up next on the programme, trade crisis averted. We'll speak with Seth Harris, the former acting US Labour Secretary, on the other side. From New York City this morning, good morning. Equity futures right now up 0.2% on the S&P 500. The payrolls report just around the corner, 8:30 Eastern time. In our survey, the median estimate is 150. The range is very wide. At the high end, Jefferies 220. At the low end, Citi 70k. In the bond market, yields higher by a single basis point. The 10-year 385.53. Under surveillance this morning, trade crisis averted. Here's the latest. Cargo back in motion at major East and Gulf Coast ports as a 3-day strike comes to a close. The union extending their contract through January 15. The ILA's local Baltimore president telling local media, quote, "We're going to receive a 61.5% increase over the next 6 years, and we're going to have other language to protect us from automation worked out over the next few months." Joe Matthew joins us now from DC for more. Joe, crisis averted for now. Let's talk about how difficult it might be to settle some ground on that language.
Well, look, you're right. This is being framed as a big win for the administration. It's a breakthrough we didn't think we'd be talking about necessarily this morning, and the administration's fingerprints are all over this. But you're right. This is about a half measure here, as Seth Harris will probably tell you in just a moment. The idea of guaranteeing no automation at the ports was just as important as the wage increases for these workers, and that has yet to be hammered out. So we're delaying what really could be the most difficult part of this whole negotiation. In the meantime, though, look, it was this time yesterday morning that Jeff Zients, the chief of staff, was on the horn with the shipping companies. They chose to divide and conquer, it looks like. Julie Su, the acting labor secretary, went to New Jersey to meet with union leaders. And it's interesting here, we can't underscore enough the role that Hurricane Helene played in unlocking this deal right now. The message from the administration was, as Ron DeSantis called up the National Guard to ports in Florida, that we have to get these ports open to get supplies to those affected by the hurricane. And that had played a large role in getting us here today.
Joe, we've seen Kamala Harris try to put some distance between her and sitting President Joe Biden. On this one, does she need to move closer to Union Joe?
It's a great question, Annmarie, and how they frame this the next couple of days will be really interesting when she's on the stump. I will note that it's not lost on us that they delivered two separate statements last night. Did you see that? Joe Biden out with one saying collective bargaining works. Then about a minute later, Kamala Harris out with one saying it represents the power of collective bargaining. That sounds like they're singing from the same hymnal, and goes on to say this is about fairness. Our economy works best when workers share in record profits. So, yeah, that sounds a lot like Joe Biden talking, doesn't it?
Joe Matthew, appreciate it. We'll build on that a little bit later. We'll catch up with Joe again in the next hour. As Joe mentioned, joining us now is Seth Harris, the former acting U.S. Secretary of Labor. Seth, wonderful to have you on the program with us, sir. Let's just explore this a little bit more. You've lived this. You know what this is like. How set expectations for us? How difficult will it be to resolve the issues around that language regarding automation?
Automation is a sticky issue. There's no question about it. And it goes right to the core of what the ILA and other unions are concerned about, and that is jobs, maintaining jobs for their members. But my sense in this negotiation is that wages was the hardest issue. And the fact that the two parties have been able to address the wages issue in what I think of as a big win for the union, I think that's going to make it a lot easier to finish up the last few issues.
If wages was the biggest hurdle, then why not just end it now? Why are they punting this to January 15th, Seth?
I think they wanted to get the ports open as quickly as possible, and the wages issue was the thing that was going to do it. The automation issue is pretty complicated. There's already language in the contract that addresses automation, but the union wants more, and I think they had to figure out how to craft language that was going to make sense. Benefits issue. I think they just needed a little bit of additional time. We'll see how that turns out.
When you look at the wage increase, 62% increase, raised the top longshoreman's wage to just over $63 per hour at the end of a new 6-year contract. Today, that's $39 per hour. Do you think that will push up costs for importers and exporters and potentially still be inflationary to the U.S. economy?
You know, when you're talking about the kind of cargo volume that comes through the East Coast ports, I mean, almost 50% of all imports to the United States come through those ports. That's a lot of money. And the comparatively small amount of money that's going to the longshore workers is just not going to have any kind of macroeconomic effect or price effect for consumers. More likely what it'll do is it'll bring down the profit level of those extremely wealthy foreign corporations that own the carriers and own the terminals. So I don't expect to see a meaningful price effect for consumers at all.
Seth, you've been in the room for these types of discussions. Can you give us a sense of what you think happened between we're so far apart, we're not even coming to the table, to less than 3 days later, we have a deal?
You know, a member of the president's mediation team said to me that even before the deal was cut, that the parties look like they're far apart until they're not. I think that the owners here, the employers here, realized that this strike was going to go on. The ILA was very serious. The ILA, I think, I don't know if they did this explicitly, but they almost certainly communicated clearly that they had to get a wage number that was at least as good as the number that the West Coast Longshore Union got, which was about $60 an hour. I think that everybody came to understand that that was going to be the floor. And once that recognition was reached, and let me say it was the Biden administration that put this $4 an hour proposal on the table that the parties ended up agreeing to. Once everybody got to that realization, getting to a deal on wages, I think became a lot easier.
There's a real question here about the sticking point that they're not going to deal with until January, which is automation. And I do wonder, as somebody who was once in a position of overseeing the entirety of the U.S. labor market and trying to be forward-looking, how problematic is it that people are concerned about their jobs in terms of automation, but if the U.S. doesn't automate certain jobs, it will fall behind and be more expensive in terms of a place to produce goods and to ship them?
Well, I think that's a very, very important question. And I think the best way to resolve it is in the manner that the ILA and many other unions have addressed it, and that's through collective bargaining. We saw a version of this same issue in the Hollywood strikes, where the actors and the writers were very concerned, and also, let me say, the theatrical and stage employees were very concerned about the role of artificial intelligence in their industry. And we've seen that across industries. The best way to do it is for the two sides to come together, for workers to have a meaningful voice at the table and to try to sort it out. Now, I would say that the ports are sort of a unique case because there's only one set of East Coast and Gulf Coast ports in the United States. If you want to bring goods into the United States, those companies have what is essentially an oligopoly, and you have to do business with them. So I think the competition argument isn't going to work all that well because there's just no competition in that market.
Seth, you're the individual who gave the line to the current president when he was campaigning and while he's in office that he should be the most pro-labor union president in modern history. Yet people are starting to wake up to the fact that the leader of this labor union makes close to $1 million a year. Do you think that's going to backfire on this White House?
Well, that really matters only to his members who just got a minimum pay increase of $8,000 each year for the next 6 years. If they think he's getting paid too much for delivering that kind of service, they're going to have to, have some kind of a negotiation over the Constitution. But I'd also point out that President Daggett's salary is about 5% of the average salary of the CEOs in the S&P 500. It's not a lot of money when you compare it to what others who are leading large organizations are getting. Not as many union leaders get that much kind of pay. That's between them and their members. But I don't worry about it in the least. These unions are democratic organizations. They can choose who they want as leaders. They can pay their leaders what they think is the right amount of money. And let me just say, my sense is they got value for their dollar in this deal.
Sounds like champagne socialism to a lot of people, Seth. It's good to catch up. Seth Harris, former acting U.S. Secretary of Labor. I like the way we're like, well, it's up to the union workers if they're okay with their boss. But when it comes to executive compensation, we don't just sit here and say, well, shareholders are okay with it. Is there a problem? Very different approach here.
There is a lot going on. That's all I would say. I'm still wrapping my head around a number of these different issues. It's a complicated moment, especially given the fact that the appearance of being part of the sort of plebeian crowd doesn't necessarily lend itself to $1 million paycheck.
8:15 Eastern Time. Big conversation coming up a little bit later. The National Economic Council Director, Lael Brainard, first on this program, on this deal, and the prospect of really closing it next month.
And she was in the room. She was on these calls with these negotiations, like what Seth said there, that these two parties look far apart until they're not. And also interesting, the West Coast ports, they're the ones that set the floor and the bar for what the East Coast ports was potentially going to get.
January 15th. Let's see where we are. January 15th in the next few months.
It's an interesting date. That's all I can say.
Yeah.
What made the change to January 15th to deal with some
we can have that conversation next as well. Up next on the program, Bloomberg's Trade Trudell on tariffs on China EVs out of Europe. Final trading day of the week, going into the weekend. Before we get there, we've got to get through payrolls Friday. That number drops in 2 hours' time. Equity futures right now positive by 0.2% on the S&P 500, heading towards the first weekly loss in about a month. On the Nasdaq 100, we're positive on the session by 0.33%. In the bond market, 2-year yields up by double-digit basis points so far this week, and we had some weight to the move, up by a single basis point at the front end into the 370s at 371.64. We'll spend some time on the commodity market a little bit later, but this is off the back of the move in crude through the week so far.
Chris Verrone said that this is notable, and even though he's been bullish on bonds, this makes him think about something different, because what you're seeing right now, you're seeing strong dollar, oil prices up, you're seeing yields higher. It's just the whiff of inflation. And there's a feeling that maybe this is something that is a new trend in markets that cannot be ignored, at least in the near term. That's something that goes to this question, this angst about how a jobs market that's hotter than expected will be treated by this market that's already on edge about inflation.
Just short of 80 on Brent, 78.80 on Brent. WTI yesterday, the biggest one-day pop of the year so far. We'll come back to that in just a moment. I want to get to this. Sterling, good dove, bad hawk. This is what we've seen in the last 24 hours. Stay with me. 131.70 on sterling right now. The pound's a little bit stronger. It was weaker yesterday. So the good dove. Let's talk about Governor Bailey over at the Bank of England. Speaks to the British press, tees up the idea of being a little bit more aggressive. Chief economist Hugh Pill comes out and says, I don't think so. Let's be gradual. Let's be steady. Who's right?
This goes to basically Mickey Bowman versus Jay Powell, or Mickey Bowman versus Austin Goolsbee, right? Austin Goolsbee comes out. We're far away from neutral. He's going to be speaking on Bloomberg Television later this morning. Then you have, Jay Powell, and you have then also Mickey Bowman coming out and saying we've got to worry about inflation, and all of a sudden you get that whipsaw. It just highlights how much this market is hinged on some of the rhetoric and a lack of knowledge of exactly what path some of these monetary policymakers are going to do.
You'd have to believe that Governor Bailey's in the driving seat. Maybe not in the same way that Chairman Powell's in the driving seat at the last FOMC meeting, but you've got to believe the governor's in charge here, surely.
So then is this a deliberate strategy to try to sort of cool some of the appetite for further rate cuts in the market? Is this basically a messaging tactic, or is this basically free speech and muddy the waters, and then we'll do what we're going to do?
Let's put it this way. The weakness on Bailey, much, much bigger than the strength on Pill. Right? Cable's up by 1/3% today. It was down 1 full percentage point in yesterday's session. I think the market sees it in a similar way.
Especially because inflation is coming down. And I think that basically that's what we've seen with Jay Powell versus Mickey Bowman. Mickey Bowman speaks and people are like, yeah, you're the resident hawk. But Jay Powell speaks and people say, yeah, he's where the committee's going to go.
Sterling, 131.71. Under surveillance this morning, a top story in the last 12 hours. US dock workers agreeing to end a 3-day strike. The International Longshoremen's Association and the US Maritime Association extending their previous contract through January 15. The two sides restarted negotiations on a long-term agreement, which will include a pay increase of about 62%.
So this is going to end 5 days before the next U.S. president is inaugurated. I think that's very telling. One thing here, it seems, according to Seth Harris, the former acting U.S. Labor Secretary, that they got what they wanted on wages. How difficult are the next few conversations going to be on automation? But the White House taking this as a win. Huge sign of relief that this is done and dusted only in 3 days ahead of this election. They were worried about inflation, and also a huge sigh of relief of everyone out there trying to get a handle on toilet paper and paper towels. My mom called me yesterday saying Costco on Long Island all sold out of paper towels after only 3 days of strikes. This idea that consumers have this reaction post-pandemic, I think, of you have to go out there and hoard because potentially this is going to get a lot worse.
Yeah, I wonder if banana sales were off the hook, especially if people wanted to freeze them. There is a bigger discussion to be had about automation, and I wonder if anyone's going to have it in terms of if the United States wants to produce more goods, especially given that a lot of the factories have been emptied out. How much can the U.S. embrace automation? How much is this a job killer? How much is this a job creator? This, to me, is a larger question, and I wonder how that's going to feature in some of these discussions, because I understand the knee-jerk reaction, but there has to be some sort of larger question mark about how this is framed.
Let's break it down in really simple terms. There were two issues on the table. We've discussed them for the last week. One was pay. The second was language around automation. Most people have said repeatedly the second one is much, much harder than the first. What have we agreed on? We haven't agreed on the second piece of this. All we've done is punt this to January 15th. Now, is it politically convenient? We can have that conversation later in the programme. How did they come up with January 15th? But ultimately, are we going to be back to square one in a few months' time?
Because ultimately, how much can these get to have a meeting of minds when there is a fundamental fissure? Is it political? Well, of course it's political. It's getting to right after the election. Question is, does this mean that we just are basically going to deal with this kind of prolonged strike at that point if there really isn't some sort of agreement reached.
The automation language is existential to these workers. This is about job security in the years to come. It's difficult for this White House that continuously says they want to compete with China. China right now moves a lot of goods in and out because a lot of that is automated.
It's good news. Enjoy the holidays. We'll deal with this in 2025. OK, so let's park this story. Let's get to the really confusing stuff. Israel carrying out bombing raids near Beirut, targeting Hezbollah commanders and facilities. Uncertainty over Israel's potential retaliation against Iran, putting oil on track for its biggest weekly gain since early 2023. Brent absolutely surging yesterday following these comments from President Biden.
Do you support Israel striking Iran's oil facilities, sir?
We're in discussion of that. I think that would be a little... Anyway.
Annmarie, the floor is yours.
Is he being too honest and transparent, or potentially is the President of the United States being a liability now, not just giving Iran a card to use on the global stage, but also potentially some political pressure on Israel, basically giving us an eye into some of the negotiations that are potentially happening between Israel and the United States, especially given the fact that earlier he said that Iranian nuclear facilities he wants to make sure are off the table. One thing is interesting when you think about the oil market. The president has himself to blame when you see the spike yesterday. But FG Energy came out yesterday saying any disruptions to Iranian oil supplies will likely push oil prices above 80 on Brent. In the absence of that, we can quickly go below 70. The gap is so wide because there's so much supply right now in the market.
That's where I was going to go. Regardless, I'm not going to try to get into President Biden's head, but I can say that the response in markets highlights just how potentially vulnerable this market is to some sort of attack on actual oil supplies in a way that maybe is not fully being recognized in daily trading.
Well, I don't think market participants would just see that strike in isolation. They wouldn't just be thinking about lost Iranian barrels. They'd be thinking about exports across the region being compromised because you've got no idea what Iranian retaliation would actually look like following those strikes.
And we have seen Iran target U.S. allies in the region like Saudi Arabia, Baghdad, that took serious supplies off the market. So the concern, and people I'm talking to, they're less concerned about what Israel does to Iran. They're thinking 2 steps ahead. What's Iran going to do after that attack?
In other words, are they going to close the Straits of Hormuz? And that's really ultimately the fundamental question about whether that creates a fissure in the oil market.
That is the number one question, Bramo. Crude is up by 1.5%. WTI just short of 75, just short of 80 on Brent, 78.80. Let's get to the latest out of Europe. Bloomberg learning the European Union voted this morning to impose tariffs as high as 45% on EVs from China. 10 member states voted in favour of the measure, while Germany and 4 others voted against, along with 12 abstaining. A kind of a shocker out of Europe this morning.
Especially because the one abstaining was, guess what, Germany, right? You have this situation where Mercedes and BMW sell an astronomical number of cars to China. How do they compete now? And also, to the point that we were hearing about yesterday, how much do we end up with the Trojan horse being the real issue of Chinese manufacturers creating factories in Europe to produce cars that ultimately send money back to China?
1 week ago today, I sat down with Annalena Baerbock, the German foreign minister. My question was, so Germany's on board with the tariffs? When she insinuated to me that I was wrong, saying that Germany was not on board with the walls going up for China, yes. Obviously, we have underlined that if China has tariffs on European cars, then we have to discuss this. Yes, they were on board. They didn't even just abstain. Huge clear signal and pressure from the autos. They voted no.
That is a big difference. Craig Trudeau joins us now. Craig, let's talk about that. The difference between abstaining, voting for, and voting against. What is Germany thinking, and where is that coming from?
I think the automakers really made an all-out push here to get the government to sort of change its view. And it does make sense when you just kind of take a step back and think about, what's happened to this sector just the last couple of weeks. We've seen 3 for 3, Mercedes, BMW, and Volkswagen come out and warn on profit. In Volkswagen's case, it was the second profit warning that they've issued in a matter of a few months. And so, this is an industry that's under pressure. These companies have a huge presence in China that is at risk here. And they're already shrinking in the Chinese market. So to potentially have this additional headwind of retaliatory tariffs in reaction to the EU's move, I think is really concerning folks in Stuttgart and Munich and Wolfsburg.
Let's get into that. Who should be worried? Those automakers? Should it be the brandy makers? Hennessy, the likes of the cognac makers out of France? Should it be the second-tier port coming out of Spain? Who should be worried here?
I think all of the above, and I think we will have a story on the wire shortly if it's not up already. The cognac industry reacting to this morning's vote, saying that they feel abandoned by France. France being one of the member states that voted for these tariffs. China has made quite clear that sector would be affected in its response to these tariffs. So, do we see some movement toward, quotas or price controls and some sort of, compromise here before, it gets, down to the point of these tariffs actually being put into place? They're essentially here already, but the companies are not being charged just yet. So there's still time, and that's something that we've heard, from some of the companies reacting to this. There's still time for a deal to be negotiated here.
So what's happening right now with all of the companies that could be affected in Europe are basically German auto manufacturers leading the charge and going and wrangling up all the other luxury product makers to try to stage some sort of appeal. What's the time frame here?
Yeah, I think the actual implementation and beginning of tariffs being charged, those would kick in early November. So we do have time before then there, as is often the case in Brussels, we see that there are many steps before anything actually goes into place. So there's a lot of elbows being grabbed and sort of ears being turned about just what's going to happen if the EU moves ahead with this. So there are opportunities, for sort of stopping this train before it goes off the tracks.
In the meantime, Craig, the fact that Germany voted against it is actually really telling in terms of what are they going to do now? Now that it is being passed, does that mean that they're going to potentially increase subsidies to their auto manufacturers? Are they going to do something else on the other side to try to offset some of the pain that could be inflicted on the likes of BMW and Mercedes?
I think one of the main sort of places where companies are pushing, at least within the car sector, is on the fact that next year we're supposed to have stricter CO2 limits come into place for the manufacturers here. Those already are causing a lot of consternation because of the slowdown we've seen in EV demand. A lot of companies coming out sort of left and right and saying, look, we just aren't going to be able to make it next year. We're going to have to pay significant fines. We're talking billions of euros. And there may be some ways out of having to pay penalties, but those aren't necessarily attractive either. It would mean sending money, say, Tesla's way. This is of course something that we've seen over years now, where Tesla had, I think maybe 5 years ago was sort of assuming that the rest of the industry was going to get its act together, figure out a way to be more competitive on EVs and no longer need to pay Tesla for regulatory credits. That's now a business for Tesla that not only has held up, but is actually taking off. And so that's something to watch for Elon Musk, that while he's having trouble actually growing this year, the regulatory credit business is looking quite nice.
Craig, I wanted to ask you a little bit more on Germany in the sense that, do you think the government was divided? Because I got a yes last week when I asked if they were on board with these tariffs.
Yeah, I think there's real divide and real sort of, fascinating evolution here in terms of, the way that this has started. I think it was, there was some unison across member states of, looking at the state of affairs, looking at the way that, just a few years ago, Chinese imports were just a tiny sliver of EV sales in Europe. Last year, they were around 20% of that subsegment of the market. And so real concern that this was also, by the way, not just a matter of Chinese companies sending EVs into Europe, but companies like Tesla, real issues in terms of even European manufacturers leveraging the lower cost base of Europe and potentially using those imports, to boost sales at the expense of local plants in Europe. That's really a cause for concern for folks in Brussels, and the reason why we saw these tariffs come into place. It is fascinating that Germany is now against these tariffs, even as companies like Volkswagen are really at risk as a result of Chinese companies and international companies increasing their presence in China and trying to leverage the fact that they can make EVs much cheaper there than they could, say, in Germany.
Craig, appreciate it. Craig Trudell of Bloomberg there on the automakers. I have to say, we talk a lot about AI and tech. For me, this is the most interesting industry on the planet right now, without a doubt. And I wonder, I think for a lot of cynical people, a lot of people skeptical of Germany's motives here, they'll be wondering whether Germany just knew they'd get the outcome they wanted without offending the Chinese at the same time and just sat on the fence once again.
Well, what it raises the question of is how do they then counter any kind of retaliation? Can they continue to get away with that in terms of avoiding some of the retaliation from China if ultimately Europe is being lumped together? To me, it raises the question, what's the idea, bigger picture going forward of how to compete on the global scale if you don't necessarily have a countermeasure for any potential retaliation?
Just a quick correction. Pork product out of the Iberian Peninsula. It's fantastic. It's not second tier, it's top tier. OK, just in case I offended anyone. All right. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Shonali Basak. Hey, Shonali.
Hey, John. New Japanese Prime Minister Shigeru Ishiba used his first speech to Parliament to emphasize his top economic priority, which is to defeat deflation. The recently appointed leader shared that he aims to raise wages, boost productivity, revive rural areas, and turn Japan into an investment powerhouse. He has asked ministers in Parliament to support his goals by formulating an economic relief package to ease the impact of inflation. And Barack Obama is launching a 4-week campaign blitz for Kamala Harris. According to a Harris campaign official, the former president plans to begin his election push with an event for the Democratic presidential nominee in Pittsburgh on October 10th. Obama will also appear in ads and robocalls for down-ballot races in the final weeks leading up to Election Day on November 5th. And the New York Mets are headed to the NLDS after an electric elimination game in Milwaukee. After falling behind 2-0 going into the ninth inning, Mets star Pete Alonso blasted a go-ahead 3-run homer to take the lead. It could have been his last at-bat in a Mets uniform with his contract expiring after the year, and instead, the Mets march on thanks to the biggest home run of his career. They now face off against their bitter division rivals, the Philadelphia Phillies, in the divisional round. John, you know that Steve Cohen is smiling somewhere. That's
I'm sure he is.
John.
I have no doubt about that. Shonali, thank you. I'll tell you someone else who's smiling. The whole of Casa Bramo yesterday evening. How loud did that get?
Well, okay, I was actually asleep because
I'm sure.
I come in the morning and very early, and I was woken up as a result of the incredible win with a very excited household that now will be glued to the television screen for the rest of the next week, hopefully.
Well, congratulations to all the Mets fans. Up next on the program, markets bracing for payrolls.
If the labor market really starts to deteriorate, then I think the soft landing story will start to come into question. That's why the Fed cut 50 basis points, a couple weeks ago. I think it'll be a decent payroll employment report.
Looking ahead to the payrolls report, we'll catch up with Michael Pugliese of Wells Fargo. This is Bloomberg. Equities just a little bit firmer, up 0.2% on the S&P 500. Bond yields just a little bit higher, up a single basis point, 385.92. Mohamed El-Erian writes in, just wants you all to know that Casa El-Erian was up late as well. Enjoying the Mets win. He's going to join us a little bit later this morning.
Congratulations, Casa El-Erian. Casa Bramo is very happy for you. Everyone's very excited, and we can't wait to just gloat in a little bit.
Can I just say to all Mets fans, I can't give everyone an individual shout out. Under surveillance this morning, markets bracing for payrolls.
If the labor market really starts to deteriorate, then I think the soft landing story will start to come into question. And that's why the Fed cut 50 basis points, a couple weeks ago. I think it'll be a decent payroll employment report. I think the estimates are around 140,000. That seems like a reasonable estimate. I think that most of the momentum is for 25 basis points at this point.
So here's the latest. Investors are awaiting September's highly anticipated payrolls print in less than 2 hours' time. The median estimate in our survey coming in at 150K among a wide range of estimates. Michael Pugliese of Wells Fargo writing, we are expecting non-farm payroll growth to have slowed slightly to 135 with an unchanged unemployment rate of 4.2. Our forecast for a 25 basis point rate cut at the November FOMC meeting is conditional on a September employment report that does not come in materially weaker than our forecast. Michael joins us now for more. So, Michael, that tees up the first and obvious question. What is materially weaker? What kind of number would you be looking at?
Yeah, I think what it would be to me is, do we come in below 100,000 on non-farm payrolls, inclusive of revisions, right? I think of it collectively, if we beat by 25,000 on the headline for this month, but then there are big negative revisions to previous months, you got to take that into account. And then a higher unemployment rate, right? Not just, flat at 4.2, but does it rise a tenth or even anything higher than that? So you've got to look, of course, at the whole picture, revisions, unemployment. But the way I'm thinking about it is, do we stabilize, right? This is an example of an employment report where I think a consensus number is good news, right? 150,000, 4.2% unemployment tees us up for 25 basis points in a month, barring any big surprises.
What's interesting is what's going on in the market right now. There's a rethink of just how much weakness actually is present, given the fact that we've had a number of upside surprises to a bunch of different economic indicators. Yesterday's ISM services data, just the latest in that string. And yet you say that under the surface, there is a stalling out in the labor market that's reminiscent of the 2010s. What are you looking at to see that type of activity?
Well, let me give you a few examples. So one, we're at a 3-month moving average on non-farm payrolls of 116,000. That's not just the slowest since the summer of 2020, but it would even be slow by the standards of the late 2010s. You look at the unemployment rate, which has risen, of course, by half a point or more over the course of the past 12 months. You look at things like the quit rate from the JOLTS data earlier this week. We're back to mid-2010s in terms of the share of people that are quitting their jobs. You look at the survey data and things like the Consumer Confidence Index. More and more people reporting that jobs are hard to get. Fewer and fewer people saying jobs are plentiful. And so you look across, I think, a pretty broad range of the labor market data. The establishment survey, the household survey, the JOLTS data, labor market surveys of households, and all of them are showing a labor market that is at best, I think, as strong as it was in the late 2010s, and at worst, kind of more of a 2015 type labor market.
So, Michael, when we look at the markets, we're seeing yields up, we're seeing across the board just inflation expectations tick up just a little bit. There's a feeling that maybe we've reached the trough and that we're going to reaccelerate from here. Do you think that that's misguided, that kind of idea?
I think reaccelerate from here is probably a little bit strong, but stabilize, right? We've seen this downward trend in things like payrolls, upward trend in unemployment, and that's our base case, is that we'll level off from here. That a pace of 125, 150,000 on non-farm payrolls, of a 4.2, 4.3% type unemployment rate will be where we level off, and that we won't see that deterioration any further. But, we're not looking for an acceleration from here to a 200,000 plus, non-farm payrolls pace or 3% plus GDP growth in kind of the next few quarters.
Who knows what's in store at 8:30 Eastern Time. Michael, we appreciate your view, sir. Michael Pugliese of Wells Fargo on the latest jobs report. 150 is the estimate in our survey. You just get the feeling, and we've had a lot of people come on this program and share this sentiment, that whatever the number is, people are just mentally adjusting that number down. And when I say people, I don't just mean investors and neutral observers. I mean people at the Federal Reserve as well, officials, central bankers.
Yeah, well, I wonder how much we're going to end up actually looking more at the revisions even today to see whether that trend continues. Because if we see ongoing downward revisions, then it will just confirm that typically when you get a weakening labor market, you do get those negative revisions. And the more that continues, the more you'll keep adjusting downward any type of headline number.
We've played up payrolls a lot. We've played down CPI. I think there's a few people out there pushing back against that view too. This was from Bank of America. Governor Waller's remarks explaining the rationale for a 50 versus 25 at the last meeting should support expectations for a front-loading of cuts with the disinflation trend intact, even if the labour report surprises to the high side. CPI next week is equally as important in some people's minds.
If people see inflation coming down as reason enough for this Fed to try to get to neutral, if that alone suggests that neutral is much lower, then essentially the jobs market shouldn't stop them, right? That ultimately strength is a good thing. And if CPI keeps on coming in lower, well, the carte blanche, go ahead.
Get back to neutral quicker.
Exactly.
The view of many on Wall Street, including, I believe, Neil Dutta. over at Renmac, who no doubt will write in a little bit later this morning. Priya Misra is joining us next of JPMorgan. We'll catch up with Evan Roth-Smith of Slingshot Strategies. We'll speak to Zentner of Morgan Stanley, who caught up with Chairman Powell this week. That's going to be interesting. And we'll talk to Becky Frankiewicz of ManpowerGroup, just what is going on with hiring from New York City. That's all up next in the second hour of Bloomberg Surveillance.
The Fed won't have to cut as many times as the market is expecting because of a reacceleration in growth.
We do disagree with market pricing that takes policy rates to below 3% by the end of next year.
I think Powell set up the case for 25 a couple of days ago when he spoke.
I think that most of the momentum is for 25 basis points at this point.
The idea that the Fed's just going to deliver 2 25 basis point rate cuts, I think, is a problem.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
I knew Neil would make an appearance at some point, and there he is from New York City this morning. Good morning, good morning. The second hour of Bloomberg Surveillance starts right now. The price action looks like this. Here's a flavour of things. Equities just a little bit firmer, up 0.2% on the S&P 500. On the Nasdaq, up by a little more than 0.25%. The main event 90 minutes away, so here are some estimates for you. The median estimate in our survey is about 150. The range is incredibly wide, 220 at the top end. That's the high from Jefferies. At the low end, Citi going with 70.
So question is good news bad news? Is bad news bad news? Is good news? Anyone who's rolling their eyes, join the club. Yesterday, Jack Manley of JPMorgan Asset Management saying that actually on the margins, good news could be bad news just simply because this is a market that is more hinged on the idea of rate cuts. Basically, Bank of America coming out with Goldilocks, which is 125 to 175,000, and that would be game on for risk assets.
John, when you look at those analyst estimates you just ran through, 150,000 jobs is the spread. It's absolutely massive. It just makes you think no one really knows what's going on, which goes to the second point, which is the fact that even Jay Powell's talking about the fact that how reliable is this data? This morning, Paul Donovan over at UBS, the monthly celebration of dubious quality data that always thrills markets. Basically, whatever number you get, you have to take a grain of salt with it because maybe 60, 70,000 will come off in the revisions.
We mentioned this in the last hour. There's just a feeling for a lot of people they mentally adjust this number lower by that 50, 60. Lisa said it last time around, and she was absolutely right. For a lot of people on Wall Street, the focus wasn't the headline jobs number. It wasn't the unemployment rate. It wasn't even wages. It was the revisions.
And so we'll get that again today. All I can say is way to pour cold water on what we do every single day. But this is sort of what the markets are doing every single day, too. And so, you can make a joke about how it is sort of this fictitious number that's going to get revised up, down, and center. But at the same time, the market's going to trade on this. And guess what? The Fed has to make a big decision based on this data.
An even bigger decision on November 7th when they meet. And there was a payrolls report that comes early in November that could have been even messier for them. Some good news. Less messy. Just a little bit less messy. The 3-day strike on East Coast and Gulf Coast ports over for now. We're going to do this all over again potentially on January 15th.
Yeah, that November 1st payroll report, looking back at October, obviously is going to become a little bit more reliable for the Fed. Now that we have those workers back at the docks, punting this to January 15th, 5 days before the inauguration, before the next U.S. president, they got a deal on wages, 62%. And Seth Harris, who's the former acting U.S. Labor Secretary under the Obama administration, saying they really wanted to make sure they were in line or at least beating what happened at the West Coast. Now this language on automation, they say it's potentially easy. It looks like it's the more challenging one. It's existential to these labor workers.
There are short-term decisions and there are long-term decisions. The short-term decisions are things like wages. Long-term decisions, and I think you could talk about the U.S., I think you could talk about Germany in this as well. There is a larger, real key question about how you're going to deal with fundamental shifts underpinning this economy, and that has to do with automation. It has to do with where things are produced, and it has to do with the West's relationship with China. All of those things kind of coming together and being pushed out further and further because no one wants to actually deal with them.
We're going to have that conversation later on this morning, 8:15 Eastern Time. The director of the National Economic Council under President Biden, Lael, Brainard, is going to be joining us on this program at 8:15. Do not miss that. Here's a flavour of the price action for you. Going into payrolls, equity futures just a bit firmer. I want to pick out one thing on this screen. Crude, very close to 75. Lisa up by 1.4%, a 4-day rally.
And it comes after Joe Biden responded to a question about whether Israel could potentially strike the oil assets of Iran. He said, quote, we're discussing that. I think that would be a little anyways. And here is what it really ignited the 5% rally that we saw yesterday. Key question is, how far could this get escalated?
Dissecting Joe Biden speak, that anyway was basically, I don't think I was supposed to be this transparent.
I would agree with you. He was thinking out loud.
He was thinking out loud, and he's
a little bit of a liability given how sensitive some of these negotiations are right now.
A liability, and also basically his administration, I think, is concerned because it's an election year. And you have to think Amos Hochstein was sitting there putting his face in his hands being like, oh my gosh, I'm trying to keep a lid on these oil prices ahead of an election. And you basically just said, yeah, maybe Iranian oil facilities are game on.
The president sparked the biggest one-day rally in crude of the year so far. WTI right now just short of 75, 74, 77. Coming up this hour, we'll catch up with Priya Misra of JPMorgan saying bad news for jobs is bad news for risk. Evan Roth-Smith of Slingshot Strategies as Elon Musk says he'll join Donald Trump on the campaign trail. And Ellen Zentner of Morgan Stanley after her conversation with Fed Chair Jay Powell earlier this week. We begin this hour counting you down to US payrolls at 8:30 Eastern Time. The median estimate in our survey expecting a print of 150K. Priya Misra of JPMorgan writing a print of 150 or higher, and the Fed will likely cut 25 in November. Payrolls around 100K or below means 50 basis points. Bad news on jobs, bad news for risk assets, and the curve should bull steepen. Priya's with us around the table. Priya, good morning.
Morning.
It's good to see you. I've got one question in the bond market, and then we can go broader and we can talk about payrolls. Why is so much money, so much cash going into money market funds right now?
Great question. As we hit another record yesterday, I would say one word: valuations. You know, the fact that you're still getting 4.5% to 5% on money funds, the yield curve is still inverted. Every asset class is priced for a soft landing. So I think people are staying in cash, waiting for better levels on bonds, better levels on stocks. I will say we're seeing significant inflows into bond funds, but people are waiting for, well, I'll buy when the 10-year treasury is at 5%. You're not getting that. You know, inflation's coming down. The Fed's telling you they're going to cut. We don't have to read between the lines on the Fed put. They're telling you it's there. If things weaken, they're going to cut much faster. And I think people who've been sort of, you know, there might be a melt-up move, because if you get a short period of volatility, we are absolutely going to be in there buying if there is a risk off. But I think, you know, there's a sense of everything is so well priced, everything's done well. Let me just stay in cash. It's still giving me 4.5%. Well, within a year, it's going to give you 2.5% or 3%. And, you know, that's when I think a lot of that money is going to start to move out.
Although it comes at a time when people are taking a look at what's going on with the oil prices. They're taking a look at what's going on with the resilience and a number of different indicators. Yesterday, we had ISM services data that came in better than anyone expected, who was surveyed by Bloomberg. And you have to wonder whether people are questioning this idea that the Fed is willing to go 50 basis points so quickly. You heard a slew of people lining up, 25, 25, 25. And then Neil Dutta saying, no way, stop it, guys. How much do you see this as sort of a given, even though you are seeing signs of strength in so many places?
So I think the data is really mixed. You can see signs of strength, then you can see signs of weakening. Look at that unemployment rate increase. Look at labor differential in consumer confidence. I think this is where the earnings report, details of the job report. You've been talking about revisions. I think revisions, look at dispersion within jobs. Is it really only 2 or 3 sectors that is creating all the job growth? What happens with margins? So I think there is, you know, a lot of uncertainty. The data is not giving us a clear picture. And every market's priced for soft landing. So I think this is where I would push back. The re-acceleration risk seems to be off the table. I think we've got really a bimodal world. You've got these binary risks, and there's a lot between the election, between geopolitical risk, between payrolls, frankly, or the entire jobs report. We're either stay in soft landing, everything is priced in, but can rates fall some more? Sure. Can spreads tighten? Absolutely, if we stay in soft landing. Or we go much worse. And I think that's the world that we're sort of grappling with.
And that's the reason why you think good news is good news for risk assets, because ultimately you do think that reacceleration is off the table. I want to pick up on that. Are you basically saying that this head fake that we're seeing in oil prices is a head fake, and that any kind of tick up in yields is a buying opportunity right now because ultimately inflation is dead?
I think so. I mean, oil price increase through supply related issues, which is what this is, that's actually a tax on consumers. So I think if it's geopolitical related, I would not buy it. If there's massive fiscal easing in China or significant fiscal easing in the US, which actually creates growth, then it's a different question. But I think oil prices is negative. Bonds are a diversifier for risk assets. We saw it the last 2 payroll reports. We had slightly weaker numbers. You got, you know, the market pricing in this higher chance of 50. Rates fell. And that's why I think, you know, if you get weak numbers, we're going to price in 50. And the whole idea of why did the Fed go 50? All those reasons are still present today. Monetary policy is restrictive. What's 150 basis points really going to do? I think, friends. Well, exactly. I think for the housing market, you need mortgage rates much lower. We're talking 4%, 4.5%. We're not, at 6%, you're not going to have that happen. You're not going to create a big positive on the housing market. So when I think about re-acceleration, I look at where are the drivers. It's not rates. You need much lower rates. It's not really fiscal so far. This is where the election, this is where China becomes important. So right now, I would say oil prices, and that's resulted in this rise in rates, it's absolutely a buying opportunity. If you've got risk on your portfolio anyway, and we do, we get a little nervous about all these binary risks. I think owning some hedges, be it steepeners, owning some duration, especially given this backup, it's an opportunity.
Priya, let's talk about the election. You went there. You say after the jobs report, the market's going to be solely focused on the U.S. election, and you say the market will move in any scenario since it is not priced for any scenario. But if you have conviction that you think Harris is going to win with a sweep or Trump is going to win with a sweep, how should you be pricing that?
It's very hard. I would say your key point was the sweep. I think what happens if it's not a sweep? But I love that you bring up sweep because I think everyone focuses on the White House, not y'all. I know y'all have talked about Congress. Congress is very, very important. So what happens with the House? And this is where the House is at a knife edge. The presidency, look at polls. I'm not even sure we can trust polls a whole lot, but the polls are very close. So, and then look at all the policies we're talking about, right from tariffs, which actually doesn't need Congress as much. Fiscal policy absolutely needs Congress. Immigration, regulation. There is so much out there that we're going to have to see, what's the make. Will we know the result on election night? I hope for all our sakes that we do. But what if we don't know that? What if it's a divided government? Then we have to see what is priority number one. And there's something on the campaign trail, and then there's actually what they talk about. So I think for the market pricing, we're going to move in either direction because there's so many unknowns around the makeup of Congress, around the presidency, and then what policies are their number one priority.
And what happens when the FOMC meets and we don't potentially have an election result?
I think they look at financial conditions and the economy, clearly. If monetary policy is still restrictive, which is likely to be, we're going to be in the 4 handle. We can debate R-star and say maybe neutral rate is not 2.5, but 3.5. It's not 4.5 or 5. So I think they continue to cut. They're going to try and be as apolitical as they can. Look at the data, the entirety of the data, inflation and growth. I think Governor Waller tells us inflation is also important. So we have to look at both. And then look at financial conditions. In the scenario where we don't have an election result, financial conditions will tighten. Because markets don't like uncertainty. You don't want binary outcomes which you don't know how to price. In that scenario, I think they cut and they tell us, well, if financial conditions continue to tighten, we'll cut more. I think that's the message we'll want to hear.
So final message from you. I'm sitting in cash like so many other people. What do I do? Where do I go?
I think you buy bonds.
Okay.
I don't want to talk my book, but I think...
Well, I had a feeling you might turn around and say it might be the Core Plus bond ETF.
If you're getting, investment grade, securitized, high yield bonds, high quality, I think high quality fixed income is sort of the best place to be in right now. Spreads are tight, but look at all-in yields. You're getting 5.5% higher than money market rates. So if you're in money funds, you're getting 4.5, or you get 5.5. And it's going to be a diversifier, especially if one of these events, when we talk about October surprise, we have multiple contenders for the October surprise. If any of them pan out, you've got that yield and you've got that hedge.
It's a massive month ahead. Priya, it's good to see you. As always, thank you. Priya Misra there of JPMorgan Asset Management with an update on stories elsewhere this morning. With your Bloomberg brief, here's Shonali Basak. Hey, Shonali.
Good morning, John. Cisco has agreed to invest in cloud computing provider CoreWeave, according to people familiar with the matter. The transaction values the company at $23 billion. The potential secondary transaction would allow existing shareholders, such as employees, to tender $400 million to $500 million of their holdings. Bloomberg reports that the deal is not yet finalized, but near completion. And 7&I is eyeing potential buyers. Bloomberg is reporting that the 7-Eleven owner is exploring a sale of its Ito-Yokodo stores and supermarkets. According to people familiar with the matter, the Japanese retailer has approached private equity funds and other entities about the sale of multiple businesses under the supermarket empire. The potential sale is part of a greater push to show a greater focus on the retailer's convenience store business. And the man who predicted the double-digit returns in Chinese equities this year now has concerns about current valuations. Invesco China CIO Raymond Ma shared that he believes that there are signs that the surge has gone too far for some stocks, adding that some lack a clear value proposition based on their likely earnings performance in some sectors. But Ma isn't bearish on an opportunity in China. He says there's still plenty of scope for investors to be making money buying Chinese stocks. And that's your Bloomberg Brief, John.
Charlie, thank you. They made a ton of money in the last few weeks, that's for sure. Up next on the program, tension on the campaign trail.
I ask you to stand in truth, to reject the depraved cruelty of Donald Trump.
If Lion Kamala gets 4 more years instead of a golden age, America will instead be plunged into a dark age.
We'll get to the latest polls up next on the program, live from New York City. On this Payrolls Friday morning, good morning. Payrolls dropping in the next hour. Equity futures into that firmer by 0.25% on the S&P 500. In the bond market, yields a little bit higher, up by a little more than a basis point. The 10-year 3.86. Under surveillance this morning, tension on the campaign trail.
I ask you to stand in truth, to reject the depraved cruelty of Donald Trump. And I ask you instead to help us elect Kamala Harris for president.
If Lion Kamala gets 4 more years instead of a golden age, America will instead be plunged into a dark age. Your family finances will be permanently destroyed. Your borders will be gone forever. They already are when you think of it, right?
It's the latest this morning. Powerful allies joining Kamala Harris and Donald Trump on the campaign trail. Former Republican Congresswoman Liz Cheney urging members of her own party to put patriotism over partisanship. This as Elon Musk says he will attend Trump's Saturday rally in Butler, Pennsylvania, the site of the first assassination attempt on the former president. Joe Matthew of Bloomberg joins us now from the nation's capital. Joe, let's go to the polls. How are things stacking up?
Well, my gosh, it depends what poll you're looking at, but this race is statistically tied in pretty much every measure when you factor in margins of error. It's really hard to say who's leading where. When you look at the swing states that matter, it's within 2 points pretty much in either direction. We talked to the Cook Political Report last evening on Balance of Power about their latest numbers. Tied in both Georgia and North Carolina, where you're finding both candidates this week, of course, surveying some of the hurricane damage here. But you're right. We've got some star power at play. Elon Musk is going to be in Butler. I suspect that's well within his right because he's largely paying for Donald Trump's ground game right now, $71 million through the super PAC. I wonder if he might end up speaking at some of these rallies over the next month. And Liz Cheney, interesting optics yesterday. That was the image of the day for these two who don't agree on a single political issue. To share a stage together, she told the crowd that she's been a Republican longer than Donald Trump has been spray tanning. I wonder, however, if it brings any undecided voters into the fold.
Joe Matthew, down in Washington, D.C. Joe, thank you, sir. Joining us now around the table, Evan Ross-Smith of Slingshot Strategies. Evan, good morning to you, sir. It's good to see you.
Morning.
Had a lot of people come on the programme since the vice presidential debate and suggest that Senator J.D. Vance did a pretty decent job of prosecuting the case and tying Kamala Harris to the Biden administration, of which, of course, she's a part of. Is that gaining any traction in the polls?
He did do a good job of tying her to Biden. And, you know, as we run out of moments that could change the trajectory of this race, right? There's a 60 Minutes interview coming up, but there doesn't seem to be another debate, whether presidential or vice presidential. Whether or not Kamala Harris chooses to break more decisively with Joe Biden is one of the few remaining questions in this election. And we've done some testing that shows that it's a pretty good idea for her to draw some contrast, some sharper contrast with the president, but in very specific ways, which is to pick a high salience issue like the economy, really inflation and price levels, or immigration, and say, I disagree on how we did this, on how Biden did this, and I'm going to do it differently, rather than saying, oh, I'm young and energetic, or, you know, we got some things right, but some things wrong. You have to get specific on something that voters care about and say, I would do it differently.
So a move from vibes to policy. Where does she need to actually inch closer to Biden?
Well, you know, there are things that Biden did that were very popular. You probably aren't going to like this, but when we test ways she could break with Biden, the most popular thing we test is her saying, you know, Joe Biden had to bring the country back from the depths of the pandemic, but corporate America got away with a lot over the last 4 years in terms of raising prices on hardworking Americans. I would be different. That tests off the charts. Number two thing is I would approach the border differently. But there are things, and of course Joe Biden has been pretty tough on prices, and he's invested in supply chains. He's done a lot, but people just don't know about it. So you're really telling people something that has already happened, but the electorate wants to hear it.
The one place where I think she probably needs Biden's help, I want to say, is the unions. When you look at the data coming out of Teamsters, because they've published all this internal data for rank and file, Biden earlier this summer was actually beating Trump. Now the numbers are Trump 58%, Harris 31% when it comes to rank and file. Mm-hmm. How important for her is it to talk to those working class individuals in places like Erie County, Pennsylvania?
Well, it's very important. I mean, the composition of the Democratic electorate has shifted, where the suburbs of Philadelphia probably weigh more on the Democratic conscience in terms of who's going to win this election than the industrial working class of Pennsylvania. But that hasn't stopped her from doing things intelligently, smartly, by like signaling on fracking and other industrial jobs, and signaling a major investment in manufacturing, subsidies for small businesses, things like this. So the working class is very important. Unions are very important. This is probably the most tension we've ever seen this late in an election cycle between the Democratic Party and major national unions. But it's fairly contained, really, to the Teamsters, who have been shaky in terms of their commitment to the Democratic Party for a while, and the kerfuffle over the ILA.
There's a number of different constituents that you've kind of keyed in on, and they have different issues that really are, in particular, that need to be catered to them. When you look at some of the October surprise catalysts, you look at the war in the Middle East, you look at the hurricane and the recovery from Hurricane Helene, you look at the potential for a wobble in the economy, which issue do you think could potentially be most damaging to either candidate going forward?
Probably any major change in the economy. Foreign policy is already the weakest rating that Biden gets as president, but voters have never really tied Harris to his foreign policy. He will have to deal with it as president, and it could affect his legacy if something changes in a major way in the Middle East. But, not to be a nothing ever happens guy, but it seems like we have a fairly well-structured election going into Election Day, of Harris up a few points in the blue wall states, tied or trailing. Your polls show her more or less tied or even with a slight advantage in the Sunbelt states, and reaching a sort of resistance level of +5 nationally.
In 2016, there was a lot of criticism about the polling, saying that people didn't want to say to pollsters that they were going to vote for Trump. And that was one of the reasons why a lot of the polls didn't pick up how much support he actually had. Is that true this time around?
I have a sort of contrarian take on this, which is, the error that pollsters are most prepared for, because of the last two cycles where there's been a polling error that undercounted Donald Trump's support, is exactly that polling error. We have, the whole industry has examined, are we getting these people? Are we getting those people? We have to make sure we get all the Trump people. The modal error, the one we're not prepared for, is some sort of pocket of support for Kamala Harris that we don't know about. We know what it looks like when Donald Trump runs for president. We have a lot of data. We've had a lot of time to prepare. Non-college working class voters, right? All of these things that have really stymied accurate polling is largely accounted for. Now, there could be another surprise, right? Muslim voters in places like Michigan, maybe. But we don't know what Kamala Harris looks like at the top of the ticket. If there's a surprise to come from somewhere, it's probably from her.
Evan, appreciate your time. As always, thank you, sir. Evan Ross-Smith there of Slingshot Strategies. We've said it repeatedly for the last few months, things are incredibly finely balanced going into this election result a month away, if indeed we do get a result in the next month.
It's on a knife's edge when it comes to the election and in the swing states. I keep going back to the unions, not just because what happened with the dock workers, but also last night, the Democratic Party got a blow from the firefighters. They are not going to be endorsing Harris. And when you look at rank and file, they lean towards Trump, at least definitely in the Teamsters, which share their data.
We'll stay on the labour market. Coming up next on the programme, we'll catch up with Ellen Zentner of Morgan Stanley Wealth Management as we count you down to payrolls in just over 60 minutes' time. Ellen Zentner sitting down with Chairman Powell earlier this week. We'll get her thoughts on her biggest takeaway with the Federal Reserve Chairman. And we'll look ahead to this one at 8:30 Eastern. In our survey here at Bloomberg, the median estimate is 150K. The previous number is 142. Going into this, equities rallying just a little bit, up 1/3% on the S&P 500. In the bond market, yields drifting just a little bit higher. But the main event this week hasn't even been the economic data. The main event this week has been in the commodity market. Crude is rallying for a fourth consecutive session. We're heading to the biggest weekly gain of the year so far. WTI just short of 75, 74, 76. 2 hours away from the opening bell, 1 hour away from the jobs report. Equities look like this, up 1/3 on the S&P 500, still heading towards potentially the first week of losses in about a month. On the Nasdaq 100, we're up by 0.4%. On the Russell 2000, we're up by 0.5. I want to tie two asset classes together, bonds and commodities. Let's start with treasuries, 2-year, 10-year, 30-year, and let's pick out the 10-year segment. Yields up for a third consecutive day, up 2 basis points this morning, 3.8630. Up big time across the curve yesterday, and this is the why. Let's talk about the commodity market. The biggest one-day pop on crude just yesterday that we've seen so far this year. Brent crude just short of 80 at 78.67. Lisa, you've been tying these two markets together over the last few days. This is what Ian Lincoln of BMO has to say. It's far less obvious that the conflict in the Middle East will be traded solely through the lens of reflationary risk. At some point, we'd assume the inflationary impulse will give way to safe haven demand and global growth angst.
Well, Priya Misra was saying this, that basically there's good inflation that actually signals a growing economy, and there's bad inflation, and that is commodity inflation from some sort of geopolitical crisis, and that usually suppresses growth and is a flight to haven type of moment, which is the reason why they continue to be bullish and see this as a buying opportunity. The sort of fly in the ointment here is that the economic data coming out at the same time in the United States has been better than expected. So trying to unpack the two asset classes can be a little bit more difficult than it otherwise would be.
Also, looking at the supply and demand picture of oil, right now prices are higher just because of a war premium, this conflict premium. That also, basically, the President of the United States did to himself yesterday when he basically was very transparent and said, yeah, we're discussing that when it comes to Israel maybe targeting Iranian oil facilities.
And instantly, 5% move on crude. I'm pleased you brought up the data. We'll spend some time with Ellen Zentner of Morgan Stanley. Spend some time with her on this in just a moment. The ISM services, again, it was another one of those prints that had something for everyone. So you had the headline read, fantastic, new orders, great, and then the employment component, well, bit of a problem here. So the same thing in job openings, didn't we? Layoffs were very low, but hiring's come down. Quits rates fallen. Got a problem here. That kind of conflict, those contradictions, we see it in the data repeatedly again and again.
It was the same with JOLTS. It was the same with ISM manufacturing. It was the same with ISM services. You look under the hood at the employment market, and that's why people are saying it is treading water. That's the reason why people say that you're on a knife's edge to the downside, not necessarily to some sort of reacceleration. Key question to me is, what makes it break one way or another? Does the Fed's 50 basis point rate cut help it break to the upside? And if that's the case, are we seeing the trough, or is this the beginning of something more prolonged?
Or can we just stabilise here for a while? Hopefully.
It doesn't ever work like
Hopefully.
that. Okay, I understand that. I hope so too.
Just,
Me too.
we all
Yeah.
hope so. We're all sharing that dream, all right?
Let's do that.
Come back to that in a moment.
Yeah.
Under surveillance this morning, US dock workers agreeing to end a 3-day strike after reaching a contract extension through the middle of January. Workers will return this morning with the two sides set to restart negotiations on a long-term agreement, which will include a pay increase of just under 62%. The pay has been addressed. But one thing that hasn't been addressed in a major way, language around automation, and that ultimately is the bigger issue here.
It is, and I think, Lisa, you put it well earlier. This is short-term gain, but long-term, it's the anxiety about what these ports, what these jobs will actually look like, and they are trying to really quell the concerns about automation because that is the direction of travel for how these ports operate, especially when you look at places like China and how they're doing it. What I can say, a massive sigh of relief coming out of the White House. You do not want to have to decide on whether or not you want to be on the side of the U.S. economy or the side of labor unions before an election.
That said, I would like to understand what kind of master plan there is, not that there ever is a master plan, but what kind of concepts there are with respect to the balance between automation for longer-term structural sustainability with respect to some of the manufacturing and the ports versus job creation. That's sort of the question of when we talked about globalization, how do you also keep jobs here? Where is the discussion about how to bridge that gap so that a lot of people don't become out of work?
We'll have that discussion at 8:15. Director Brainard from the National Economic Council. Look out for that conversation on Bloomberg TV a little bit later on this morning. So this is the good news for the Federal Reserve. This data was going to be really messy. It'll be less messy now, but there are still some difficulties in this country, including this one. Rescue crews continuing to search for survivors in the areas around the floodwaters of Hurricane El-Erian. The death toll rising to at least 215 people, with more than half of those in North Carolina. Hundreds more remain missing.
The pictures are devastating, and people have lost their livelihoods, and a lot of people moved to some of these areas, and they didn't even think of some sort of hurricane risk. Now the question is, and actually a real big concern, and we talked about this with the governor of, with the Congress member from Tennessee, if we get another storm, even a big bout of rain, and there is another one coming, How much does that add to the complications of recovery and rebuilding of a lot of these areas?
One, when is Congress going to come back if they need more money in terms of supplemental funding? But also, these two stories, when it comes to dock workers and the hurricane, are connected. It was that final push to the union to say, okay, actually, emergency materials are needed. We cannot hold the economy hostage at this time when now Hurricane Helene is now one of the deadliest storms in modern history.
A really difficult moment for the people of those states. We'll continue to cover that story, of course, on Bloomberg TV and on Bloomberg Radio through today. I want to turn to the latest out of China. Economists at Nomura warning that China's historic stock rally could quickly turn to a bust. The bank's saying that China's economy stands on much weaker footing than it did before the pandemic, with a number of vulnerabilities, including its housing sector, high local government debt, and geopolitical tensions, including the tensions around the automakers in Europe this morning, which is the latest news we got out of the continent.
Saying it could go back to 2015, the boom and the bust, and sort of the losses that people saw after that. Okay, I get it. That's why people are saying it's a trade. It's not necessarily owning it, right? They're renting the trade, but they're not owning it. Let's see what they can do. I mean, we also hear from some economists saying that the bazooka could mean $1.4 trillion of bond sales to fund stimulus. So I think a lot of people are in wait-and-see mode.
Everyone was all excited. They went out for the party, but now they're waking up to the hangover. And that is the fact that, look at I can't get over the youth unemployment rate in China. It's near 20%, and that's the data we know. So what you see now is any of this going to trickle down to the real economy? That's the big question mark.
Christian Mamani raised this, and I think it's a really interesting point. He referenced the post-GFC period in the US economy, and he said the policy reaction ultimately did enough to stabilize financial markets and lift financial conditions, but it didn't do enough to address the economic vulnerabilities, and it remained that way for a long, long time. And he's making the suggestion that maybe that's what we're seeing take place in China right now. It's enough to lift markets. It's not enough to address the weakness that we see, the vulnerabilities we just pointed out in the broader economy.
How many times do we say the stock market's not the economy?
All the time.
How many times do we say that the financial markets and the conditions there are getting increasingly divorced from the fundamental economy? If that's true in the United States, just think how much more so in China.
Really interesting point. Let's turn back to the US economy. It's all about the labor market.
So many measures, the labor market is still solid, but it really has cooled. Our conditions have cooled considerably. And as I mentioned, we don't think that labor market conditions need to cool further from where they are. The measures we're taking now are really due to the fact that our stance is due to be recalibrated, but at a time when the economy is in solid condition. That's what we're doing. We're recalibrating policy to maintain the strength in the economy, not because of weakness in the economy.
There is a familiar face on the left side of the screen there. That's Ellen Zentner of Morgan Stanley Wealth Management. Ellen, good morning to you.
Good morning.
Fantastic conversation earlier this week. Congratulations.
It was. It was a really great conversation. We covered a lot of topics.
What was the big takeaway for you?
So, Chair Powell seemed very relaxed. His baseline is 25s. You heard him. The economy is on strong footing. I think it was easy going into this conversation that we had important data last week showing that gross domestic income had such a significant upward revision where we had more spending, more income, and the savings rate still got revised up, meaning we also have a greater savings cushion than we thought. You pair that with the coming downward revisions we know or we're going to get on employment, those are huge productivity numbers. And so that's a lot of comfort for a policymaker that might have been worried that consumer spending was going to drop off quickly or jobs were going to drop off quickly. So it was a pretty relaxed conversation. But importantly, I wanted him to say publicly that that employment report during blackout before their November meeting will matter. And so that's one reason why I'm only focused on the unemployment rate today.
So this introduces your own analysis of the situation. So let's get to it. How low do you think the bar is for that 25 that you've got penciled in to turn into a 50 in November?
I think the bar is fairly low if the unemployment rate continues to rise. And here's the thing, you can get a healthy employment number today. You can get a healthy employment number in November, but if the unemployment rate continues to rise, because that keys off of a different report, that's the household survey report, and that is the sole measure that Chair Powell is watching. And so if that continues to rise, well, you've hit your threshold. You said we won't tolerate more weakness in the labor market. And so I don't think, especially when rates are this high,
that there's a particularly high bar to get to 50.
That said, even Jay Powell has talked about how the rise in unemployment doesn't represent a weak market. It represents an increase in the overall jobs market in terms of the supply of workers. So why does this sort of become the most important indicator if he himself has said maybe it's not measuring weakness per se, but just a change in the demographics of this labor market?
So I think that very much has been the case for some time. He talked about the impact of immigration, greater supply into the labor market, and for some time that has been driving the unemployment rate higher, and it represented just a better balanced labor market. But we moved into balance some months ago, which means we're starting to move into an oversupply at a time when companies are slowing hiring. And so further rises in the unemployment rate will be for the wrong reasons.
Did you get a sense that Jerome Powell is fundamentally more dovish than the rest of the committee? Because we've all just been assuming that that's the case, and that's what we get from the rhetoric. But did he seem to feel like he was really the consensus in terms of having this predilection to making up words today, it's Friday, excuse me, to cut by 50 basis points?
So I think that the fundamental issue is that the economy is okay, and there's not any forcing issue here to cut rates. When the data is deteriorating quickly, when it's sort of slapping policymakers across the face, you'll see how quickly consensus comes together. And so it seems very disparate on the committee because there's no particular emergency, right? You're cutting in a healthy economy. It's just that rates are higher than they should be. And that's why he keeps calling this a recalibration. And so without sort of an emergency driving factor, the views are all over the place, and we try to figure out is Powell driving the consensus? Is he strong enough to pull consensus? Is anyone in the middle with him? I think he has plenty of supporters in the sense that we could do 25 or 50. You know, the data will tell us what we need to do. Do you buy into the narrative that businesses are holding back on hiring or firing because of the policy uncertainty surrounding the election and what next year brings? I mean, certainly election uncertainty does create paralysis in decision making. We can see that there's no churn in the economy. There's not a lot of churn in the housing market, not a lot of churn in the labor market. People aren't feeling confident to leave their jobs and look for something else. People, when they're separated from jobs, are having it's taking longer to find another job. And yeah, companies have been sitting on pretty, sustainable level of payrolls. They don't really need to ramp up hiring. They aren't cutting. And so it's just sort of a stasis. And certainly policy uncertainty probably has something to do with that. But I also think that, we sort of reached a point where payrolls are kind of lean and exactly what companies need. And there's not any particular deceleration or acceleration in the economy to drive a change.
If that's the case, and the unemployment rate maintains at 4.2%, could we see a Fed that doesn't cut in November?
No. I'm gonna say, look, I don't put a 0% probability on anything. That's burned me in the past. So let's say a 5% probability that they actually don't cut in November. I mean, we have so few data points before that meeting, and I think given that, using Powell's own word, given that there's ample room to cut, right? You have room to continue to draw rates down, and especially because inflation remains muted.
Just a bit of bow on it. Can I ignore inflation data next week?
Yeah. I'm going to say yes.
That's a new world.
I'm going to say yes.
Why is that?
I'm going to say yes because let's say that it surprises to the upside. Well, then that's the first upside surprise in a string of really solid disinflation numbers. And so it's just one print.
I'll ask another question to put a bow on it. Can we remain in this stasis, this lack of churn, for a very long time?
Probably not. I mean, this is something that you said at the beginning of the segment, right? That typically when you're sort of in this kind of neither here nor there area, it's going to break up or down, and it's likely to break down, not up. Given all of the global risks you all spoke about, given the election uncertainty that you brought up, I mean, it's hard to point to upside risk to the economy here.
Ellen, appreciate your time. Wonderful work this week.
Yep,
Don't take our job. Ellen Zentner of Morgan Stanley Wealth Management. Ellen, thank you so much. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Shonali Basak. Hey, Shonali.
Hey, John. President Biden's latest effort to lower student debt has hit another setback in a federal court. The ruling from a judge in Missouri argues that the plan is an unconstitutional overreach of executive power. A coalition of 7 Republican-led states sued to block the rule from taking effect last month, and Biden's plan would have canceled up to $20,000 in debt for about 30 million borrowers. Rivian shares falling pre-market after the EV maker cut its full-year production guidance. The company saying that it's going through a production disruption due to a supply shortage that's become more acute in recent weeks. Rivian is revising down its estimates for vehicle productions by around 10,000 units, now calling for under 50,000 new vehicles to be made. And Spirit Airlines sinking in the pre-market amid efforts to avoid bankruptcy. According to people familiar with the matter, the struggling air carrier is seeking new financing from creditors and in exchange to extend its current debt. The months-long negotiations have not yet led to an agreement, and if the airline is unable to reach a deal, it may be forced into bankruptcy. The company has until October 21st to find a solution to its financing woes in order to maintain a key partnership with U.S. Bank. And that's your Bloomberg Brief, John.
Shonali, thank you. More from Shonali in 30 minutes' time. Up next on the program, choppy waters in the workforce.
If things are so strong, why is the unemployment rate up? One thing that's not really revised is the unemployment rate. I would just point out that the unemployment rate has been rising despite this seemingly strong economy.
That conversation just around the corner, live from New York. This is Bloomberg. Payrolls 42 minutes away. Equities right now up around 0.25% on the S&P 500. Under surveillance this morning, choppy waters in the workforce.
If things are so strong, why is the unemployment rate up? One thing that's not really revised is the unemployment rate. I would just point out that the unemployment rate has been rising despite this seemingly strong economy. Growth may not be strong enough to keep the unemployment rate from rising. If that's the case, that means that the labor markets are exerting downward pressure on the wages of those that are already working.
So here's the latest, here's the state of play. September payrolls due in just over half an hour. Markets on edge for the next sign about the state of the labour market after this week's ADP and jobless claims. Data signalled stability. Becky Frankiewicz of ManpowerGroup writing, going into today's report, our data signals that we're in a labour market that is treading water. We're staying afloat with steady demand when you look at the top line figures. However, there is an underlying weakness that is leaving some employers and workers feeling stuck. Becky joins us now for more. Becky, let's talk about that churn and what might be behind it. And welcome back to the programme. Some people have pointed to election anxiety just holding some employers back. What do you think it is?
Yeah, I think there's a host of uncertainties surrounding the labor market. I listened to Ellen on the last piece around inflation. I would say consumers definitely are looking at the inflation numbers. You know, they're shopping with their wallets that feel lighter every time they go to the store or to the gas station. And so while the rest of us may not be watching those numbers, consumers will definitely be watching that and feeling that next week. And so I think election uncertainty is part of it. But really, we're just seeing this treading water labor market, as I mentioned. You know, we're not going forward because employers are concerned about, is the economy really going to turn in a positive direction? Workers are staying put. They're a little stuck. So the great staycation is back again. But more importantly, John, is the undercurrents that I want to talk about that we're seeing. They're indicating some weakness in the labor market. Top of that list for me is blue collar workers. Blue collar demand. So we look at real-time job demand, not BLS, which is a look in the rearview mirror. But real-time demand for blue collar workers is down 3.1% month over month and 4% year to date. And when you dig into those numbers a little bit deeper, you'll find it's frontline manufacturing supervisors that are down 19%. Why is that? It goes back to your question because employers are really watching where they're spending their money and taking note. Do I need production or do I need production supervisors, and making those trade-offs? That's a big area of weakness that we're watching. The other area is hyper concentration of demand. So we have overlying steady, you dig in, blue collars down. Then we have this hyper concentration, and a whole new breakout in the September numbers that we're looking at is around science and R&D. Like, we're digging deep to find growth in the labor market, and driving that growth are statisticians, which are up 400% month over month. And you look at who's hiring statisticians. Amazon trying to get a hold before holiday hiring on what consumers are looking to spend on. So a couple of areas to watch as the numbers come out today.
And Becky, I think that's a brilliant picture, a real deep dive on where we are in the labour market right now. Reveals a bigger question than we've been asking all week. Where are the layoffs? Where are the layoffs? Why aren't they happening?
Yeah, we're still seeing companies hold on. I mean, it's like it's the staycation again on both sides. They're holding on to their talent, not doing layoffs, hiring at a steady rate, John, but not at an astronomical rate. Again, we're digging deep to find month over month growth. When you're looking at statisticians and physical therapists, we're not seeing the big pieces of the economy grow. And so they're not laying off workers. They're holding on to their talent. The internal mobility, as I talk to CEOs across the country, big buzzword. What does that mean? Instead of letting someone go, I move them to another job and work to keep them. It was so difficult to find talent at one point. So we are seeing layoffs. They're not depressed, they're just steady. And in this economy, you would expect them to be higher. But the emotion of the labor force, we talk a lot about the data, the emotion, the feelings. There is still fear, even on the employer side, and they're holding on to their workers.
Becky, you said something that I want to pick up on, that statisticians were the ones being hired. And I think of that kind of staff being used for different kinds of artificial intelligence and automation and different kinds of computer programming that a lot of people say have been driving efficiencies. Based on the data that you're seeing, are those efficiencies coming at the behest of job growth, or is it actually generating a new form of job growth that is just going to take time to show up?
Yeah, well, we know the data would show it's not having a negative impact on jobs today. And candidly, it's not having a positive impact yet. When I say statisticians are up 400%, that's 37,000 jobs that were posted. In the grand scheme of the economy, that's still, it's a big number given it's growing, but it's a small number. And Lisa, for the first time in 9 months, 9 consecutive months of growth in AI and machine learning occupations, we saw a decline. And yet we saw this rise in statisticians and mathematicians. Why is that? It's because companies are taking a step back and saying, okay, AI is coming for sure. There's a lot of hype around it. What do I need to do now versus getting ahead of myself with AI? I need to get foundational data. I need data that I can organize and aggregate and pull from in a way that helps me make informed decisions. And I believe that's actually a very foundational move for the labor market and a good one for the future. We're going to see AI grow again, make no mistake. But the first step is making sure your data is stable. But even before AI, you can do a lot of analysis on data, which is what we're seeing hirers like Amazon, Walmart start to do.
Becky, we're at the start of the year where holiday hiring kicks off. How is it looking right now?
Yeah, so slower start to the season, Annmarie. If I was on this time last year, I would have been telling you we're ready for an early start to hiring. We're seeing that demand pick up. We're not seeing that demand pick up yet. I know the estimates out are about 520,000 holiday jobs. That's lower than we saw last year. But I think even within that, what we're seeing that's interesting is it's going to be another brick and click holiday season. Brick, we're seeing increase in demand for retail salespeople, retail supervisors. On the click side, again, statisticians. So last year, I would have told you logistics. We'll see logistics pick up. Things have to get from point A to B, but the statistician piece is new. But I think even more interesting than all of that is the approach that employers are taking to hiring. So we have UPS, Macy's, Target, these kind of companies prioritizing the candidate experience. Like, how do I actually hire someone? For UPS, you can apply and get a job offer within 10 minutes, an offer, not an interview, an offer. For Macy's, it takes 5 minutes to apply, and they've committed to an offer within 48 hours. So we're actually seeing this war for talent show up on speed and reflecting the candidate, which is another reason, John, why we're not seeing layoffs. And it's because employers are still feeling like employees have a lot of power in today's labor market.
As you were talking, Lisa was thinking about applying. I could see The wheel's churning.
For what? A UPS driver?
Macy's, UPS, see how quickly it works.
Are you trying to get? Actually,
I'm just
it's totally
wondering
true as an
how fast it
experiment.
works.
I know exactly.
I
I want to see like the response time. Stop knowing me.
I read your mind.
It's really annoying.
Becky, thank you. Becky Frankiewicz of ManpowerGroup. Some real depth on where we are in this labour market.
I thought that was a fascinating conversation, this idea of a step back, a lot of technological changes happening very quickly. How do we assess how to do it in the smartest way? And that's the paralysis maybe before potentially a breakout in a positive way, but how long it's going to take before we get there.
Big hour. Coming up next on this programme, Nadia Lovell of UBS, National Economic Council Director Lael Brainard, Mohamed El-Erian of Queen's College, Cambridge, and Jeff Rosenberg of BlackRock. The third hour of Bloomberg Surveillance up next. The jobs report, 8:30 Eastern Time.
The Fed's laser focused on the labor market.
If the jobs data does diminish, I think they have to go ahead with the 50 basis point cut.
I think it'll be a decent payroll employment report.
We're going to have a pretty messy payrolls.
This jobs report that we're going to get this week, this should be clean, but this might be the last clean one, at least for a couple months.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Annmarie Hordern.
8:30 Eastern Time. It's 30 minutes away. The jobs report just around the corner. The scores going into it look like this. Up 0.25% on the S&P 500. On the Nasdaq right now, up by 0.4% through Thursday, heading towards the biggest weekly loss on the S&P going back a month. In the bond market, yields have been creeping higher over the last 3 days, largely off the back of the move in crude. Less of the commodity market, much more about the labour market for the next 60 minutes or so. The estimate in our survey, 150K. Looking for unemployment to stay at 4.2%, but as Lisa has said repeatedly over the last month, for many people on Wall Street, there should be an extra line in there now. It should be about revisions in America because a lot of people are putting much weight on that than they are on this.
Because ultimately it makes a big difference if you see 165K, which is at the north side of the estimates by Goldman Sachs, and you strip off 60,000, suddenly you get to where the low calls are for, say, 70,000 from what we hear over at Citigroup. The question for me is whether we're going to see revisions, whether that's going to move markets, or whether it's going to be the unemployment rate, because we heard that from Alan Zentner. And then we heard Neil Dutta, unemployment rate, why is it going up, unemployment rate? So how much does it make a difference if it's 4.22% or if it's 4.26% and gets rounded up to 4.3?
It's a hard payrolls report because of the estimates. 220 is what Jeffries has, and then 70,000 on Citi. It's an ocean. And when you look at some of these estimates in terms of how far apart they are, Priya, Misra, though, the question remains, we are normalizing or going below trend. And that really is some of the details we want to see from this report.
Got CPI data next week. Ellen Zentner of Morgan Stanley on the programme 15 minutes ago saying, don't even look at it. Basically, not precisely her words, but essentially that was the message. That was the essence of the argument. Don't even bother. It's all about the jobs report now.
It was the same essence that she made that also we heard from Priya Misra, which is the inflation threat, in her view, is dead. The idea of oil and somehow the tick up that we've seen being an inflationary threat is anachronistic because ultimately that will be a tax on people that will slow growth. So that's basically the argument that people are making. That said, I do wonder, listening to what Becky Frankiewicz is saying, if companies are just sort of in stasis, girding for a number of uncertainties, whether it's what's going on in November or also some of the technological changes, that's a very different picture.
You mentioned crude, 4-day rally on crude, the biggest weekly gain of the year so far after the biggest one-day pop we've seen so far in 2024. Brent crude right now up another 1.3%, just short of 80. WTI getting closer to 75, up by 1.4.
The latest surge coming from the spike in oil prices from the words of the President of the United States. Asked directly, would you support an Israeli attack on Iranian oil facilities? We're discussing that. Crude immediately takes off. But the issue is now, is the president being very transparent, or potentially is he a liability in these negotiations because he's being so transparent? And then is he moving oil markets because he's basically saying, yeah, there's potential there's going to be more disruption in the oil market out of the Middle East?
Well, if you're running for election and you're worried about higher crude prices, liability. Ultimately, 78.63 on Brent crude, and a lot of that is down to some comments from the President of the United States yesterday afternoon. Big hour coming up on this programme. Coming up, Nadia Lovell of UBS as investors await September payrolls. We'll catch up with the National Economic Council Director, Lael Brainard, as US dock workers agree to end a 3-day strike, and Mohamed El-Erian of Queen's College, Cambridge, on the Fed's 50 basis point insurance policy. We begin this hour with stocks on hold ahead of the Fed's next big data point, September payrolls, and in just under 30 minutes' time. Nadia Lovell of UBS saying this: the macro backdrop and fundamentals are favorable for equities. The economy is growing at a healthy clip and the Fed is easing monetary policy. We look for an additional 50 basis points of cuts this year, with the potential for more if the labour market weakens. Nadia's with us around the table. Nadia, good morning.
Good morning.
It's good to see you. Let's talk about what you're expecting in 26 minutes and whether good news is truly still good news.
Yeah, we think so. I mean, we think that the market will, react positively if we get, 150 to 200K and the unemployment rate remains stable or even tick down. We know that everyone is watching the unemployment rate. That's what Powell is focused on. And so if that ticks up, it puts 50 basis points on the table for November, but we're not quite there yet.
The data this week has been really hard to read. Lisa mentioned the ISM services number we got in the last 24 hours. Headline number, great. New orders, brilliant. Employment component, concerning. Had job openings earlier this week. Job openings higher, decent, but then you saw hiring slow. Then you started to see the quits rate come down as well. Slightly concerning. What are you telling investors, your clients, to do with the incoming information right now? Should they put more weight on one versus the other?
I think when you look at the data as a whole, it does still point to an economy that's still growing. You look at where GDP now is tracking. We know that some of the employment data has been noisy, but you also need to listen to what companies have been saying. Is monetary policy restrictive? Yes, we saw that in the survey comments in ISM, but, it feels like the growth is still there. When you look at some of the revisions that's happened, and I'm talking more specifically on the savings rate, Lisa, that the savings rate is actually higher than previously thought. So the consumer has more of a cushion than people had thought, and consumption has been driven more by income growth. So when we look at all that together, that still paints a pretty favorable picture for the economy and for equities.
That said, as John mentioned, there was this increase, a further increase to a new record in money market funds, because there clearly is a whole bunch of uncertainty right now. Still, however, valuations are very high. It's not as if a lot of that heat has been taken out of the market. How much do you push back against the argument that it is difficult to get bullish from here just based on valuations, considering all the potential risks that we have coming forward?
It is definitely something that we're cautious on. Reality is we do think that near terms that the market could get choppy. We're heading into the elections. We also have geopolitical risks. And then we're in October where there could be potentially incremental information around export bans on U.S. semiconductor chips. So we have been advising our clients to really prepare for a pickup in volatility and using some hedging strategies to help mitigate some of that. But that said, even though valuations are elevated, a lot of these companies are growing into that valuation multiple. When you look out in the next year, we still think that you can get high singles to double-digit earnings growth, and that will help in terms of companies growing into that multiple. Ultimately, we think that with the positive economic backdrop, that this is a market that could get to 6,200 by the time we get to next year. So choppy near term, but into year-end and into 2025, we continue to encourage clients to use pullbacks to add to the market.
How much does that 6,200 prediction hinge on the idea of a pretty accommodative Fed, one that is much more predisposed to cutting by 50 basis point increments rather than 25?
I think that's a great question, Lisa. I mean, our core view is for 50 additional this year and then 100 basis points next year, sort of a quarterly cadence. Of course, if the data breaks down, we do expect that to be accelerated. But when you look at the data so far, I mean, as Powell has noted, it doesn't feel like monetary policy needs to be acting at a fast pace. We expect it to be more gradual. And so we're not factoring in the sort of rate cuts that the market is now pricing in. And we think that equity markets can absorb that 100 basis points next year and sort of a trend back towards neutral rate.
Nadia, you said you're watching the election. You currently give a slight edge to Kamala Harris. Does that mean for the market, the risk is going to be corporate earnings rather than inflation because of tariffs?
So when we think about the election, we assume that Harris, 55% probability that she wins, but most likely with a divided Congress. I think the thing that we're very most closely concerned about is a Democratic sweep, because that has implications for corporate taxes. Could it go to 28%? If it does go to 28%, that's a mid-single-digit drag on S&P earnings, and it's probably the same sort of reaction from a market pullback standpoint. You remember when Trump, lowered corporate tax rate, several years ago, we did see the market rally 10%, but that rally did not happen until we got more details on that. So we do think that needs to be watched, and also even in a Trump victory, tariffs could be quite disruptive to markets.
And that's unilateral. When it comes back to a potential Democratic sweep, and you think that could be worse for the markets because of the changes to the tax policy, how much drawdown could we see, say, like on the S&P 500?
I think you can see a knee-jerk reaction in the days after. Hopefully it's just days after Election Day that we know the results. You could see a knee-jerk reaction, a couple percentage points. But again, the market is going to wait for some details because we know promises are made. They don't always translate into policy, and the devil is in the details. And last time the Democrats were here, Sinema pushed back. Now, Sinema won't be an issue this time, but another Sinema type could arise, and push back on the raise to corporate tax rate.
How much are you watching, just sort of in the panoply of potential risk factors, how much are you watching what's going on with oil prices as a potential catalyst for you? How do you play that at a time where it's considered a growth dampener should it persist?
Absolutely, and that's the word, persistence. We do know that historically, like a $10 move in oil prices sustained over a 3-month period could be, 40 basis points, 50 basis points of headline inflation, but in reality, in core inflation, it's a couple of basis points. So not overly concerned about that. Our oil view near term, we did take a little bit off the table in oil after Biden's comments and the spike that we've seen in oil prices. We are still slightly positive on oil, but reality is we think that there's going to be this remaining concern about supply, excess capacity. We know that, the OPEC, 5 to 6 billion barrels a day of excess capacity that's potentially in the system, and then Libya as well this week. So the oil market hasn't really tightened this week. What we're seeing is a geopolitical risk. And so we think that oil can get above 80, but not much beyond that.
We've gone through about 15 different topics. What do you do every morning when you come in? Do you just say, what's the unemployment rate? What's Jay Powell going to do? How do you sort of parse through these risks and figure out which ones you should really be focusing on? The risk that we're watching doesn't change every day unless there's some sort of headline. Which has been every day, but carry on.
Which isn't every day. But yes, absolutely, monetary policy is important. We want to at least get 25 basis points in the next meeting, and agree with Alan's comments earlier that we think that we will get 25 basis points. And I think the rhetoric around the election cycle and ultimately what eventually happens with elections is also important. And then we have, tensions in the Middle East. If that escalates and there is a disruption to oil supply, that has further implications as well.
Well, the good news is we'll have something new to talk about next Friday. Bank earnings just around the corner. Can we finish on the financials?
Absolutely.
How are you guiding people into financials in the earnings season?
Yeah, so we are positive on financials. It's sort of our call option on lower rates, the economy, easier regulation, and potential for return of capitals. Now, next week, earnings could be mixed because there is a timing mismatch. That first cut does have impact on assets-sensitive banks, and so it will take some time for that timing to resolve itself. And so we think that NIM net interest income could be under pressure in Q3, but by the time we get to 2025, we do expect to see some growth in that. And so we think that in 2025, the outlook for banks do improve.
Appreciate it. It's good to see you, as always, on Payrolls Friday. Thank you. Nadia Lovell there of UBS. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Shonali Basak. Hey, Shonali.
Hey, John. A prolonged strike has been averted. U.S. dock workers have agreed to end a 3-day strike that paralyzed trade on the U.S. East and Gulf Coast and threatened to become a factor in the presidential election. The International Longshoremen's Association and the U.S. Maritime Association have announced the decision to extend their previous contract through January 15th. Work will pick up again today, and the two sides will restart negotiations for a long-term agreement, which will include a pay increase of about 62%. And people familiar with the matter are telling us that the European Union has voted to impose tariffs as high as 45% on electric vehicles from China. The results have not been made publicly available. The European Commission can now proceed with enforcing the duties. Sources telling Bloomberg that 10 members voted in favor. Germany and 4 others voted against, while 12 abstained. China has threatened its own tariffs on European dairy, brandy, pork, and cars. Alphabet's Waymo has announced that it will expand its fleet of robo-taxis with Hyundai's electric vehicles. According to a joint statement from the companies, Waymo's sensors and software will be built into Iconic 5s in significant volumes at a new Hyundai plant in Georgia. On-road testing of the Hyundai EVs will start in late 2025. The two companies are also in talks for other opportunities outside of the EV supply agreement. And that's your Bloomberg Brief, John.
Shonali, thank you. Up next on the programme, a trade crisis averted. We'll catch up with the National Economic Council Director, Lael Brainard, in just a moment. That conversation up next. the open in about 1 hour and 15 minutes away. Equity futures on the S&P 500 positive here by 0.25%. 8:30 Eastern time. The jobs report just around the corner. The number we're looking for, 150K. Under surveillance this morning, a trade crisis averted. US dock workers ending a 3-day strike that temporarily halted East Coast trade. The union extending its contract through January 15th, allowing more time for negotiations and avoiding a contentious labor and economic battle just ahead of the election. Joining us now, I'm pleased to say, the National Economic Council Director, Lael Brainard. Director Brainard, thank you very much for giving your time to Bloomberg TV this morning. The first question we all have is how much progress have we actually made ahead of January 15th? You've been a big part of the conversation. Could you share some of that information with us?
There's tremendous progress. The most important thing, our ports are back open. Our dock workers are back at work. American consumers really won't see any effect of this at all. And again, we see that the collective bargaining really works when you support it and give it a chance, which is what the vice president, the president have always done. In terms of the progress at the bargaining table, for many months, the two parties hadn't been working together. Now they have extended the contract in order to really roll up their sleeves and address the remaining issues on the table, having now solved the wage piece of this. So good news for everyone, I think.
Some people would argue the remaining issue is the hardest issue. It's automation. And they're trying to work out whether this punt, if we can call it that, was about the election, just to push this out to January 15th, or whether it was about doing the patriotic thing and making sure that we could get the things we needed to get to the disaster zones across this country following the hurricane, from the ports and through this country efficiently and effectively. Can you share with us, Director Brainard, what this was really all about?
Absolutely. So on the part of the carriers, the port operators, and the dock workers, you know, they all wanted to get back to work. I think it was a patriotic effort. We wanted to make sure that the hurricane supplies are moving and that consumers don't see any effects, as well as American farmers and exporters. So I think on all sides, there was a real desire to get to a solution that could carry them forward, get back to the negotiating table, get those ports open, get back to work.
Director Brainard, what does the White House deem acceptable when it comes to the language on automation?
So we really don't take a position on how the collective bargaining process resolves. What we do care about is making sure that we support the collective bargaining process and allow the parties to come to conclusion that works for both sides. And that's the role we really played here, was bringing the two sides together, encouraging them to find something that they could agree on. And they did find agreement on wages and agreement on extending the contract to January 15th. So I think what we did was support the collective bargaining process, support the parties getting back to the table. The rest is really up to them.
You've done a lot of work, though, Director Brainard, when you came into the West Wing on supply chain and supply chain resiliency. How does the White House weigh, given all your work, the fact that we could have more efficient ports? Is that more important, competing with China, these efficient ports, or union jobs?
So, of course, what is very important is to make sure that we are making all the improvements that we can to our supply chains. And as you know, we have massive investments now through the bipartisan infrastructure law in our ports. We also have a supply chain council at the cabinet level that I run on behalf of the president. So we have much more data across the supply chain. There is a flow office now at the Department of Transportation that helps all the participants, the carriers, the operators, the retailers, the farmers, have the data they need to plan ahead and to mitigate. And that process was on display in the wake of the Baltimore Bridge collapse, and it was on display in the weeks leading up to this successful extension of the contract and resolution of the wage issues.
Do you think there's a chance that we can get to the automative language of this before January 15th?
I think that the carriers, the operators, and the dock workers know they have work to do to find an acceptable outcome on that and many other issues. But I have a lot of optimism now that they're talking to each other that they really made a good faith effort on the wage piece, and that moved these negotiations forward again. You know, they had not been speaking to each other for months, and our interest was really getting the two parties back to the bargaining table on the basis of a fair wage. Don't forget, these dock workers, in the previous 6-year contract, some years they got no wage increases at all. Other years they got $1. Meanwhile, we had COVID. We had dock workers really risking their lives to keep goods moving on behalf of American consumers and businesses. And the port and carriers really during this last few years had record profits. And this is a deal that could give workers their fair share after a period of having very little wage gain. So it's a nice, important step forward. Of course, they have more work to do.
Director Brainard, I can say I'm really impressed in your ability to focus with them mowing the lawn and yelling behind you, because honestly, it's always sort of unfathomable. They're always mowing the lawn there. So thank you for that. I am wondering, though, Director Brainard, how much you see a sort of necessity for workers to have to be kind of flexible at a time of great change, and that there are some technological changes that are more easily implemented if companies have the ability to figure it out as they go along, to not necessarily be beholden to contracts that were written in a different time. How do you argue that labor negotiations should continue with organized labor if companies need to have that suppleness at a time of great change?
Yeah, so what I would say is when you look at the contract that you saw on the West Coast ports, for instance, which was a very successful contract for workers, for all of the employers. It is a contract that resolves those issues and moves forward. And I expect the same is possible in the context of the collective bargaining process that now has been extended into next year on the basis of a really strong wage offer. You know, unions are more popular than they have been in decades. And I think the president, the vice president are demonstrating by their actions, this is how we enable the collective bargaining process to work. And the collective bargaining process does reach fair wages for workers, and also a set of other really important agreements about how workers should have voice in the way the business is organized. All of those things are on the table, and we believe that we have just enabled that collective bargaining process to continue in a very productive way that's good for everyone. Most importantly, getting the ports back open so we can get those supplies to areas affected by Hurricane Helene.
Lisa is getting to a much broader and more philosophical point, though, Director Brainard, that perhaps we can finish on. We are all vulnerable to automation. It is somewhat easier to be so pro-union when union membership is so low. If it was a whole lot higher, it would be far more disruptive. We'd all be complaining about being vulnerable to automation. How do you suggest that the American public should deal with the increase of use in AI and automation over the next several years? Should we all just go on strike?
Yeah, so what's very interesting there is unions have actually worked with the organizations representing employers on AI provisions. One of the first contracts to directly address artificial intelligence was, of course, the writers' contract, a really great contract, which had language that used AI as an enabler to enable writers to actually be productive, but kept the creative direction in the hands of humans. And of course, I think those are the kinds of principles that we have supported here at the White House. You know, we've released principles. It's just important for workers to be enabled, not displaced. It's important for workers to be sitting alongside businesses in making sure they work together on where AI should be used.
A much longer conversation for another time. We appreciate your time. I know you can't talk about the payrolls report. It's still to come. Director Brainard, thank you for your time. Your payrolls report is up next. 150K is the estimate. It's 4 minutes away. This is it. It's why we get out of bed in the morning. As we always say on a Payrolls Friday morning, good morning to you. It's 20 seconds away. Equity futures right now up 1/3% on the S&P, up 0.4 on the Nasdaq 100. On a Russell, up by 6. In the bond market, your scores, 2-year, 10-year, 30-year. Yields bleeding just a little bit higher, up 2 basis points on a 10-year, 3.8649. The jobs report, the estimate in our survey, 150,000 with the print. Here's Mike McKee. Good morning, Mike.
Worth getting out of bed this morning, John. Look at this. 254,000 jobs were created in the month of September, the BLS says. The month of August revised up to 159,000 from 142,000. Remember, we had been talking about how we were seeing all the revisions go the other way. The unemployment rate falls to 4.1%. Call Stephen Stanley at Santander. He nailed that. He said that could happen. Average hourly earnings up 0.4 on the month, which is a surprise because this was a short month. The estimate was for 0.3. Average hourly earnings up 4%. So the labor union people got to be happy with this because they're getting paid more. 34.2 is the average work week. That goes down a tick. So something for them to be unhappy about. But the change in manufacturing payrolls down 7,000. Change in private payrolls 223,000. And that is certainly much higher than we saw from ADP on Wednesday. So on overall, a really strong payrolls report, which is not what anybody was really expecting. People thought maybe in some categories, but this is overall just really, really strong. And it'll raise questions about whether we're going to have an inflationary issue.
Yeah, just a few. Mike McKee, there'll be some other people shouting at the screen right now. Hike interest rates following a jobs report like that. I'm joking. Some people might say it, though. Looking at this report, a monster upside surprise, and this is what it looks like in the equity market. So far, good news is good news. We're up by 0.4% on the S&P 500. As we always say, we'll see if this sticks. We're up by 0.6 on the Nasdaq. On a Russell, we're up by almost 1 full percentage point. Push this story through the bond market. As you might expect, a 2-year, 10-year, 30-year that looks like this. We're higher by almost 15 basis points on a 2-year yield, 3.8552. On a 10-year, we're up by 10 basis points at 3.9478. And once you've seen a move like that, you know what foreign exchange looks like. It looks like this for the euro against the dollar. A break of 110. Never mind 111. We're down to 109.76 on euro dollar. Mike McKee, that is a monster upside surprise. You've had an extra minute to take another look. What jumps out for you?
Well, here's the amazing thing is we were within 0.2% of getting a 4% unemployment rate. When you go out to 3 decimals, it was 4.051, down from 4.221. So that's a major move, and it does suggest that the labor market is a lot stronger than we anticipated. The level change in the labor force wasn't that big, 150,000, but employment in the household survey up by 430,000, while unemployment fell 281,000. So a really strong household survey produces an unemployment rate of 4.1% that is, for all intents and purposes, interchangeable with 4%.
I'm so glad that John went through it because I was just completely in shock, sitting here with my mouth open, trying to figure out how people could have gotten it so wrong. This was basically a report that nobody was expecting, even the most optimistic and bullish members on Wall Street. What could be accounting for how wrong people understood this to be? And the fact that every single person who we talk to who's looking at the underbelly of the employment market says there's stasis, there's churn, people aren't hiring. How do we understand this?
This is going to raise a lot of questions about where did all this growth come from and how did it slip under the radar. Now, a shout out to the folks at Bloomberg Economics who did produce a preview piece that noted that the home base data, which is a weekly report on hiring, had suggested a very strong employment report. And that, I guess, people put that aside and looked at both what's been happening in recent months and the QCEW revisions that we got and just the commentary that people aren't hiring, and they adjusted their formulas that way. But this is certainly higher than anybody anticipated. 220 was the high for us, and Wall Street was looking at a whisper number of 151. So you can see why there's some straight lines on those graphs right there.
Mike, Luke Hawa on Twitter goes, and that's what happens when the Fed cuts 50 basis points, folks. So what does this mean for the Fed? I mean, 50 clearly off the table, but potentially could this mean no cut?
No, I think, and I would have said this going into this is not the most important jobs report since the last one, because we have one more before the next Fed meeting.
It's always until the next one.
And now with the port strike over, that one should be much cleaner. We still have the Boeing folks on strike. Maybe the administration can settle that one too. We know there will be an impact from the hurricane. Hurricane Francine hit during the reference week for September, but the BLS says there was no impact from the hurricane on the data. But there will be an impact from the Helene. And so we'll be able to look through that. But that one will really set the tone for the Fed, because if we're going to see 2 months of strength, then yeah, maybe they back off and wait a month, wait a meeting.
Mike McKee's going to stick with us. Let's go through this again. If you are just joining us, welcome to the program. Monster upside surprise, 254. We were looking for 150. As Lisa suggested, the range was pretty wide, but nowhere near this. 220 was the high over at Jefferies. The low was 70 over at Citi. The number's 254. It's not just that. The revisions are positive. Wage growth is solid, and unemployment got very close to 4.0%. We're back to 4.1. Once you put all that together, look at the equity market picture. Equities up by 0.5%. The Russell up by more than 1 full percentage point. Check out the bond market. Front end of the yield curve. Yields up and away. Already a big week for high yields at the front end of the curve. We had another 17 basis points to that move, 387.39. And in foreign exchange, a much stronger US dollar against the euro. Euro dollar breaking 110. It's 109.70. With us around the table is Stephanie Roth of Wolfe Research. Stephanie, you said the sky isn't falling. It's better than that. What is this?
It's a solid print. The 3-month average is now 186. Previously, if you were to rewind a month ago, the 3-month average was 116. We were looking for positive revisions because August historically tends to get revised up, but it got revised up and even more. So it's a labor market that looks okay. And to your point, probably 50 basis points is off the table for the next meeting.
But does this raise the question that we are systematically underestimating how much strength there is in the U.S. economy and, frankly, where the neutral rate is? Because that's where the conversation is going to go next.
That's certainly where the bond market's going to be taking it, that's for sure. Yeah, I think that's fair. And 3% consumer spending is probably going to be matched by a labor market that's doing okay and not kind of deteriorating in a big way, which is what we learned today, right? It didn't make sense before when we were sitting here with real consumer spending running around 3, even above 3%, with concerns around the labor market. Those things just don't go hand in hand. So yeah, we're sitting here with an economy that's running pretty solidly above trend. Labor market's doing just fine. It's probably unlikely we'll get another 50 basis point cut. The economy's kind of doing okay. It makes sense for the Fed to be cutting, right? 5% interest rates is too high for this economy, but they can go at a slower pace.
It's worth noting that a month is a long, long time. There's always a risk of extrapolating out these numbers this morning through the future. November 7th, we could be waking up on November 7th, the morning of the next Fed meeting, with no outcome of the election. As Mike McKee suggested, some real hurricane damage in many states across this country in the United States. So you don't know how much weakness is going to come up. I've got no idea what the number looks like on November 1, just as I had no idea it would look like this on October 4th.
So it's very difficult to come up with a real sort of portfolio of data. The thing that stands out to me is that this is across the board. Every single data point that we have gotten until now, you could find something for the doves, you could find something for the hawks. If you're a dove, good luck finding something this. I'm sorry, Andrew Hollenhorst, not a great day, but this is sort of a question here of how much you're looking at an economy where suddenly the revisions are going in the opposite direction.
This is hard this morning. This feels like a big outlier, though, compared to the data we've had this week, particularly when you look at things like job openings, when you look at what's happening with hiring, when you look at what's happening with the quits rate. That number didn't scream a market that looks like the one we've just seen this morning.
Which is the reason why you're going to get a lot of people talking about what exactly happened here in terms of the actual data collection and how messy it is, given the fact that we have had so many questions around that. And I'm sure those questions aren't going away today as we see the 2-year yield rise some 16 basis points and then some, with everybody just absolutely reversing trades that have been put on recently.
Let's get to the market view. Jeff Rosenberg of BlackRock with us, Mohamed El-Erian of Queen's College, Cambridge with us as well. Jeff, I want to come to you first. Your thoughts on this, and as a market participant, what do I do with this?
Yeah, I mean, clearly, as was just described, this is, across the board, a very strong report. If you look in the under components, retail, professional services, education and health services, all significantly beat above their 3-month running average. And, across the earnings and the household survey, this is a very strong report. As was mentioned before, the revisions in terms of August was kind of expected. The home-based data and the alternative data, you had some people looking at that as well. Maybe not to the extent, Bloomberg and Anna Long did and emphasizing it, but you certainly saw, some data points that were pointing towards, the potential here for a stronger report. But this is stronger than anyone expected. And as Lisa said, and I think this will be the longer run debate, and it's something we've talked about on this program a lot, the debate about not only where kind of policy is, how restrictive it really is, where, R-star and neutral stands, but something else that has really been missing from this Fed's conversation that was present in past cycles. They've abandoned it, and that is the impact of financial conditions. Financial conditions say that this is a much easier monetary policy, and you look at where growth is, and it's kind of it's a concurrent signal, but growth is running well above potential, and that really tells you that this is not as tight of a Fed as the market, or really as the Fed thinks it is. Today is maybe another data point kind of in support of that view.
Mark Rowan, Apollo, earlier this week, financing is available. Real estate prices are going up. It's not clear we need more rate cuts. To the extent we accelerate the economy and have to go in the other direction, that would not be a good day. Mohamed, I want your early views on this jobs report, and what on earth does the Fed do with this one?
So thanks, John. 4 takeaways, including for the Fed. One, on the labor market. This is not just a solid labor market, but if you take these numbers at face value, it's a strong labor market late in the cycle. 2, for the economy, it speaks to U.S. economic exceptionalism, something we've seen and something that's continuing. 3, for the Fed, it means push back much harder against pressure from the markets to put you in the single mandate box. Enough talk about inflation is dead. Inflation is not dead. Enough talk about the Fed should only be concerned about maximum employment. It should still be concerned about its dual mandate. And finally, for the markets, I think this is pushing back against what has been, in my view, and you've heard me say it over and over again, an overly aggressive expectation of rate cuts by the Fed. I think this will get the market closer to what's likely. And then we're going to have a debate on 2 things. One is, where's the neutral rate? And 2 is, how do you think about this economy in terms of growth and employment, and how are these 2 things coming together? So, at face value, this is a report that will cause a lot of revision, both in analysis and in market pricing. But I stress it is part of a much bigger picture of mixed data. And that's where the complications arise, John, as you know.
Mohamed, Annmarie nailed it when she started saying, how much does this have to do with the 50 basis point rate cut? And it's somewhat tongue in cheek, of course, but at the same time, there is a real question. How much have the easier financial conditions that have basically been manufactured by this Federal Reserve helped boost a market that wasn't maybe in need of such a big boost?
Look, my view, we've been living in a world of liquidity dominance. It has been all about liquidity. That world was reinforced by a 50 basis points cut. Let's also remember that the market didn't expect a 50 basis point cut based on data. It expected it based on a reporting on the Thursday before the Fed board meeting. So there was no economic conditions that would justify 50 basis points, but there was a leak to a newspaper that moved market expectations. I worry that we continue to feed this monster of liquidity dominance. And at some point, we may regret it, either because inflation will not settle at 2% and or because financial instability will result from excessive risk-taking.
Mohamed, is there a chance that we can have a no landing scenario?
Sure, there's a chance that we can have a world in which there are positive things happening on the supply side, and we can be, quote, bigger but not hotter. Yes, that is part of the distribution of potential outcome. I think a soft landing is still the 55% probability. Bigger but not hotter is 15%. So add them two up, you get 70. And then you have a 30% probability that either because or because of weakness in low-income households, or because of a Fed policy mistake, we end up in a recession.
Looking at these numbers, and Mohamed, thanks for being with us. You're going to stick with us. If you are just joining us, welcome. It's about 8:45 Eastern time this morning here in New York, and about 15 minutes ago, we got a blowout jobs report. 254,000. The median estimate in our survey was 150. Lisa's talked about the revisions repeatedly. The revisions were good. They were positive. If you look at the unemployment rate, we've dropped back to 4.1% from 4.2. Mike McKee suggesting we came very, very close to dropping to 4.0. Wage growth was hot as well. A lot of this was very unexpected. We've said it repeatedly through this morning. The range of estimates stretching from anywhere between 70 at the low side and 220 at the high end. Nowhere near this one at 254. Off the back of this report, equities are positive on the S&P 500 by 0.7%. On the NASDAQ 100 up by close to 1 percentage point. On the Russell, we're up by 1.5. With us around the table, Stephanie Roth of Wolfe Research. Stephanie, I want to throw this one at you. There will be a lot of people in this country that don't believe these numbers. They will look at them, and some will say sarcastically, snarkily, they will say, if you're the Harris campaign, you couldn't have written this jobs report any better even if you wanted to. There are others who look at this, perhaps a little bit more sophisticatedly, and say that even the chairman himself is mentally marking these numbers down by, let's say, 50 or 60,000. Should we be doing the same thing this morning?
I think that's fair. And if it was a weak report, that would have been the initial thing of, okay, well, now if you subtract out the 68,000 that we got from annual revisions last year, now we're in trouble. The initial reaction to this jobs print isn't necessarily that, but it should be. So perhaps the conclusion shouldn't be the economy's on fire or there's no landing. It's probably that we're actually hitting the soft landing. If you take a straight 3-month average, you're at a little above 186,000. Then if you subtract the QCEW, then you're at a trend that's kind of normal. So I think the market reaction is probably going to be a bit extreme on the back of this. We should probably look through it. Last night the concern was we're headed for a recession. Now the concern is no landing. It's probably somewhere in between.
Jeff Rosenberg is good news. Good news.
Good news is good news here. I think the key, going back to what Mohamed said, is the market had been very aggressive in terms of its pricing for the Fed. Partly maybe that pushed them into the 50. You had more than 225s for the November and December priced in. That's obviously pricing out here. And, next week when we get the CPI number, you may have, as Mohamed was suggesting, more of a debate as opposed to a one-sided debate where we shifted completely away from inflation as the focus back to growth. Having a little bit more balance here is going to make the outlook a little bit more challenging. And I think for the bond market, it's going to have to reassess its pricing in terms of how aggressive it has been pricing, as Mohamed pointed out, very aggressive from the get-go here in terms of expecting, the most extreme in terms of what the Fed was going to be able to deliver. Hard to say whether next week you get that surprise. I don't think we're talking about here inflation going back up and an inflation scare. That's not the point. The point about no landing is that the last mile from 2.6% inflation down to 2% may be harder to achieve. And why it's harder to achieve is because growth and financial conditions are not as tight as the nominal rate suggests. And so you don't have to necessarily be as aggressive on securing the soft landing because the inflation side is pushing back. That's what you're seeing here this morning in terms of pricing. It makes the front end here a bit more rational in terms of pricing in less than 250s to the end of the year. And I think that's starting to be more of the story pricing out of the bond market.
Jeff, how offsides is this market? And we saw this being sort of sniffed out earlier this week, this idea that people were thinking, wait a second, maybe we overplayed just how many rate cuts there would be, just what kind of dollar weakness there would be. How much does that trade, the steepening curve, all have to unwind as people reassess with this data?
Yeah, and as you pointed out, it started earlier this week. You've had some better data. The labor market data hasn't been as one-sided in terms of the fears, in terms of negativity. There's still a preponderance of the steepener view because when you're in a Fed cutting cycle, and we're in the beginning of the Fed cutting cycle, it's about how fast and how front-loaded it's going to be. It's also about the terminal rate and where it ends up. But generally, when you're in that time period, the steepener market reaction is what you're going to get. And you're starting from a very flat point of the curve. The problem for the steepener trade is timing. You need the pace of steepening to overcome the negative cost of carry. And fast levered players don't have a lot of patience for that negative carry. And so that can, as we're potentially seeing this morning, kind of exacerbate the moves on the headline. Going back to the birth-death model and what Bloomberg Economics has been highlighting, yes, this may be overstated in terms of the headline impact, and therefore may be overstated in terms of the impact of the market move. But the overall message here is that this is still a normalizing labor market, but not necessarily normalizing to the point where the Fed has to deliver consistent 50s to secure that soft landing.
Mohamed, one thing that you've talked about is that this is an overly data-dependent and data point-dependent Federal Reserve. It seems like everyone expects this Fed to still cut at least 25 basis points. Do you think that they have moved to a framework that is less data-dependent if the data actually suggests that the labor market is doing just fine?
Yes, I think they're moving that way. It started with Chairman Powell's Jackson Hole speech. It continued in his press conference. And I think they are moving away from being overly data dependent to also trying to have a forward-looking view of where the economy is going to settle.
Mohamed, does next week's CPI report matter to you at all now?
It matters to me, Annmarie, and the one that's going to matter even more is the one after that. Yes, it does matter to me. I think Jeff is absolutely right. This notion that the last mile was going to be easy, this notion that inflation is dead, this notion that we are mission accomplished came way too early. And I think we're going to see from core inflation why certain parts remain sticky. Meanwhile, headline inflation is going to start moving up after not this month, but the next month. So yes, these CPI prints still matter. And of course, they matter a great deal to the American people.
Mohamed, talk to me about what kind of numbers you think we have to get accustomed with. Are we talking about stabilizing at these levels for inflation, or are we talking about the real risk of re-acceleration, given what's happening in the commodity market, what we've seen out of China, and the easing that's come from the Federal Reserve, that after a jobs report like this, some people are thinking has come prematurely? How real is that re-acceleration risk for inflation?
So to the extent we have an equilibrium rate of inflation, for today's economy, it would be 2.5% to 3%. If the Fed had the option, which it does not, if the Fed had the option to set a new inflation target, that is where it would make sense. We will settle, I suspect, somewhere towards the upper end of that because, as Jeff said, financial conditions are extremely loose. There are two factories of credit, two factors of liquidity. You heard it in your interview with Mark Rowan. There is not just the official factory, which has produced a ton of this, but there's the private factory that's getting more and more efficient and producing more and more credit and leverage and looser conditions. And we are living in a world where these two factories are still operating at quite a high level. So there is a risk, John, that we will settle towards the higher end of that 2.5% to 3%.
Stephanie, I'm struck by the fact that given this report, we've all been thinking about organized labor working on the dock worker strike, with the Boeing strike as being sort of at the end of labor having the leverage. Is that a wrong way to look at this, especially given the fact that wages went up? Is it actually that employees have still the upper hand when it comes to demanding work and demanding to be paid?
I don't think that's an entirely fair way to look at it, in the sense that if you look at ECI for union versus non-union workers, there's a clear lag from union to from non-union to union, in that you get a big acceleration in non-union wages and then unions tend to follow. I think this is really just a catch-up, but a catch-up from a really big acceleration in wages. So this is kind of a lagging indicator. The wage number, yes, it was 0.4, but it was, if you look at the three digits, it was 0.369. So yeah, it was strong, but if you look at an average pace, you're still running a little bit below 4%, in which case it's not really concerning.
Final question for you all, and I'm going to say it up front so you all don't have to, and you can answer with just one word. There's a lot that can still change in the next month, but as things stand, your best guess for November 7th for this Federal Reserve, and these are the choices: 50, 25, or no cut at all. First to you, Jeff Rosenberg.
I'm going to go with 25, Jonathan.
Mohamed?
25.
Stephanie?
25.
Let's see how much changes in the next month or so.
Yeah, exactly, where the potential pressure becomes one way or another. It seems hard to see that they're going to go 50, given this kind of data?
Absolutely can't go 50. I think everyone's jaws are still on the floor in this. The politics of this, for me, are very interesting. This is a fantastic payrolls report ahead of the election. This is going to do a lot for the Harris campaign.
Mike McKee, final word?
Chiefs? Oh, no, this is not the NFL. You're looking for... So a couple of things that came up here that I think are really interesting is people were thinking that the numbers might be boosted by the birth-death model, which people have blamed for the QCEW revisions. Well, birth-death model subtracted 128,000 jobs from this month's total payroll. So that's interesting. Steve Stanley, I mentioned him earlier from Santander, also was looking at the impact of college students going back to work who had been working in the summer. That drops them out of the labor force, and their unemployment rate fell from 7.8% to 7%. So that may have some of the impact here on the unemployment rate.
Mike McKee, enjoyed this morning. Thank you, sir. Just a blowout jobs report. Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock, Mohamed El-Erian of Queen's College, Cambridge. To all of you, thank you. The price action going into the opening bell, up by 0.8% on the S&P, massive outperformance on the Russell. Your day ahead and your week ahead looks a little something like this. Bloomberg catching up with the Chicago Fed President Goolsbee at 10 a.m. Eastern on Monday. More Fed speak from Kashkari, Bostic and Muslim. Tuesday, we'll get to the trade balance on Wednesday, Fed minutes, Thursday, CPI, and another round of jobless claims and some Delta earnings. And on Friday, PPI, UMich sentiment, and a ton of bank earnings. Wells Fargo at JPMorgan kicking things off. Your lineup around this table looks like this. We'll be catching up with Katrina Dudley of Franklin Templeton, Bob Dole of Crossmark Global Investments, Michael Collins of PGIM Fixed Income, and Greg Dacko of EY. For all of you out there, thank you for choosing Bloomberg TV. It's just a wow to close out the trading week and an equity market that's rallying hard. From New York City this morning, good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.